We've yet to see the full effects of the previous tightening come through into the real economy.
We have structural imbalances here in the U.S. that no one wants to deal with in Washington.
The bigger concern would be that things get unruly in China.
I think the Fed is going to be paying very close attention to the path of energy prices ahead.
The Fed will do what we all expect it to do, which is to pause and basically indicate they're data dependent.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
From the City of London for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. The only reason we're on tour, it's Bramo's birthday. Happy birthday, Bramo.
Thank you.
That's a hit, isn't it?
Well,
Happy birthday,
thank
Lisa.
Thank you. I appreciate it.
What else are we doing on the birthday tour?
Well, I'm going to go to Camden this afternoon, and
okay,
maybe we'll, a Tots game, I think, is probably in the works.
Are you going to have hot brown water with the king?
Hot brown water.
Brown
You're really
hot brown
you're
water.
ingratiating yourself.
Hot brown water with the king.
What is hot brown water?
It's a proper hot water.
Tea with crumpets.
Okay, let's restart. Live from the City of London this morning. Good morning, good morning. Here all week for you with some fantastic guests as well. Let's start with equity futures on the S&P 500. Positive here by 0.1% on the S&P. TK, not talked about enough this morning at all. We are very, very close to cycle highs on a 10-year this morning. 434 in America.
I think it's completely underplayed the market. You're dead on. I look at the 10-year real yield just as the benchmark, buttressed right up against 2%. Anything through 2.02, 2.03 would be something new. But you're absolutely right. This is underplayed right now, and that's going to change abruptly as we go. There's a meeting on Wednesday, I believe.
There is, and there's another meeting on Thursday at the Bank of England. There's another meeting on Friday at the BOJ. TK, your favourite line, that phrase from the Disney movie, A Whole New World?
It's a whole new world
after all.
A whole new world.
A whole new world. Where 21% price wage gains don't make it happen, don't get it done?
For the American audience, I mean, it's stunning to land here, drop off the Gulf Stream at Heathrow and come in to a strike of junior doctors in 75 years, much like UAW, but in 75 years, you've got NHS strikes here over the shocking pay these guys make. Residents, they're making next to nothing here.
Compared to the United States.
Oh, it's amazing.
Well, auto workers as well, Bramo. Let's go through the numbers. Starting at 40%, down to 36 at UAW. Stellantis say, OK, let's go. Let's go up through 20. And nothing. Tumbleweed. UAW does not want to play at all.
Which raises a question, what will get it done? It's unclear. If it's not 20, if it's not 21%, if it's not 22%, if it's not extra sick days, if it's not anything else, is it just the full thing or else nothing? And this does tie together with the angst that you're seeing in the bond market. Basically, people coming out and saying this is going to keep inflation present for a longer period of time.
Well, what's Mari Barra do? I thought her conversation with David Weston was really apt. She was pretty tough about it and all. Does she dial 1-800-MUSTANG and, call up Ford and say, let's go, what are we going to do? I don't sense any of that here as we begin the week.
Jim Farley, Ford, we've never seen anything like this. Dazed and confused. Lisa, we talked about the strategy coming into this ahead of the deadline. We were talking about how they might target one over the other. Traditionally, that's the playbook. Mr. Fain has not followed this playbook whatsoever.
And that was by design. That wasn't necessarily a bug. It was a feature of this entire program. It was to surprise. It was to shock and awe, to try to claw back some of the concessions that were made in the aftermath of the financial crisis and ahead of artificial intelligence and key changes technologically.
To me, so much of this, including the tension in the United Kingdom, is get it while we can, because if you lock in a disinflationary tendency, as many people suggest, you better get it while you can. Do you like my bow tie?
It's beautiful.
What
does it
represent? It's a Ferrari bow tie. Yeah, for those of you on radio,
over the weekend. Nice.
It's like very Carlos Sainz,
Okay. You want to talk F1 or move on?
No, we'll move on.
Okay, good. I thought we were going to talk Formula One for a moment. Thank you, Ferrari, over the weekend. Let's start with the price action. Equity futures here positive by 0.1%, going into the central banking triple header this week. Federal Reserve on Wednesday. On Thursday, some Bank of England action. On Friday, the BOJ. Looking at this bond market, Bramo, I think we've got to talk about it again. 434 is so close to cycle highs, and I cannot believe waking up this morning it's hardly been talked about, with crude near new highs for 2023 alongside it.
And driven by real yields that are bumping up just a hair away from 2% at a time where people are gaming out. What does this mean longer term? Feeding into this argument, 10 a.m., and I think this is really important to watch. Saudi Energy Minister Prince Abdulaziz bin Salman is going to be speaking at the World Petroleum Congress in Calgary. I am so curious what he says about how much they're going to prolong their production cuts at a time where Brent crude is bumping up against $95 a barrel. Meanwhile, today, the UN General Assembly is holding its 78th annual session this week. Of note today, Vice President of China, Han Zheng, is meeting with Secretary of State Antony Blinken on the sidelines. Very curious about this, which came together quickly and quietly, especially in light of some of the tensions that have been percolating between both nations and the European leaders and China as well. And today, kicking off a week of the monthly housing data dump, 10 a.m. we get the U.S. NAHB Housing Market Index. Housing affordability is the most negative, the worst it has been in the history of this series going back to 1986 by the National Realty Association. And I'm wondering at what point you start seeing that feeding into some of this price-wage spiral. Rents are getting really expensive.
Big time.
Home prices are not affordable. How do people deal with that?
As we're in London, should we share some local knowledge?
I think so.
Rents in London up more than 17% year over year. 17.1%. Now, compare that to New York. We were talking about Manhattan rents being up something like more than 7% year over year. Bravo, 17% year on year. That is just absolutely phenomenal for all the wrong reasons.
And you wonder why people are striking. And you wonder why people are saying we got to get paid more. It is staring at them in their face when they see their rent increase, when they see their bill at the grocery store, when they see their petrol bills. See, I'm adapting.
Petrol. Do you like that? It was nice.
I was just like, I'd like to be able to tip
we got
the
this.
waiters and
Are you bringing
waitresses.
this back to New York? It's just petrol while we're here.
Well, while we're here.
Gasoline when we get back
I
to
think
New
she's
York.
got a British accent going.
By the end of the week.
I'm not Madonna.
Give Bramo till
Bring
Friday.
in Jeff Hugh and
Oh, digs at Madonna. Sorry for that, Lisa.
No.
Jeff Hugh joins us now, Senior Market Strategist at BNY Mellon. Good morning, Jeff.
Got a British accent.
It's good to see you. Yields at 5% at the front end, pushing cycle highs on a 10-year. Dare I say it, is this the new normal? Are we getting comfortable with this?
Well, let's go back to Tom's point about real yields, okay? You can deflate via CPI, headline CPI. What if we deflate nominal yields by wage gains or potential wage gains? So then if you take the 20% or between 20 and 40% real wages, nominal wage gains, if realized, then real yields actually are very, very negative still. And then central bankers have to catch up. So there's a risk here, going back to your point about a wage price spiral that isn't going away anytime soon.
What is the x-axis on real yield? So here we are at 2%. I've done some fancy math. I get to 2.20. Maybe I'm still here at 2%. Whatever it is, there's a length of this new real yield. Where's the tension point out into next year?
So basically, you have to identify where potential GDP growth is, medium to longer term growth in the US. If that's a headline number, nominal number, 3 to 4%, then find your inflation target. Then if it's still 2%, right, then real yields, you still need to get to 2 to 3. Right.
To go nerdy on a Monday, R minus G, are we at a risk here where the interest rate becomes less than the small g, as Blanchard and Stiglitz, among others, worry about?
I'm glad you brought up Blanchard because I want to bring up another paper between him and Chair Bernanke.
Yes,
when does this become a problem?
Such a nerd fest over on the port side of the desk.
Favorite part of the morning. In terms of wages versus price spiral, and with the oil prices going where they are right now, you get a price spiral according to that paper when labour markets are tight. Yeah. So here are the unions making the gamble or the determination in manufacturing, labour markets are still very tight right now in the US.
Which raises a question, is this signal or noise? Because this is, yes, it is now tight. Although on the margins, you're seeing signs that you are getting some sort of labour market softening. Right. Is this the last gasp, as John was asking, of labour market power? Or is this something else that does have a stickier nature?
I'd say on a broader basis, this does feel like a last gasp if I look at things globally. But on the other hand, I'm an FX guy at the end of the day. Relative, it's all about the relative differentials. I think US labour markets tighter compared to what we have in Europe right now. So on that note alone, probably Labour has more bargaining power in the US compared to in Europe.
Does that mean dollar weakness?
I would say, short-term, dollar strength, that's still going to be in play because that puts the Fed on a more vigilant footing, to borrow an ECB phrase. But net, I think pretty much that is in the price right now. So let's see where we're going to be.
Very cliché of you, Jeff. Let's talk about Powell on Wednesday. On Wednesday, we get a set of projections. Yep. Most people assume that for 2023. When we look at revised growth figures, they're going up. Yep. When we look at revised inflation figures, they're going down. What does 2024 look like for you and the team?
Still 2024, it's less about are they going to hike further. It's more about how long do US rates stay where they are. And that is what the BOJ will be looking at. And what, so you didn't mention Central Bank of Brazil, Central Bank of Turkey, and the Central Bank of South Africa, the Swiss, they're all deciding. And when they look at their nominal effective exchange rates, they'll all be looking at the Fed. How long can the Fed's projection keep the dollar strong? And then they'll have to calibrate their own forecasts.
Is that dollar problem bigger in Europe right now for you than EM?
I think that dollar problem is bigger than Europe because EM across the board, if you look at Brazil, for example, much higher real rates. So they've got the buffer, Europe does not.
Georgieva surprised us with a low 5-year growth view. Suddenly, oil 94. For Jeff Yu, where is the price of Brent that's a tip point that really accentuates that global slowdown?
Let's look at the individual markets. For example, China's at a slowdown already, no matter what, China, unless you're looking at a real re-acceleration in China, which is not my base case, to 5 or 6%, then you get into a demand issue on top of a supply issue. That becomes a problem globally, and then that could be a tipping point. But right now, if it's just the US alone, and given US energy independence, I think it's much more manageable.
I'm glad you mentioned China. The Wall Street Journal had this big expose. China might be weaker than you think, and Tafak has talked about focusing on the housing market. Other people have said, including Leland Miller of the China Beige Book, that from a U.S. perspective, this is what people want to see, but it's not actually what's happening on the ground, that there's actually a great deal of strength. Having been in China a couple of times recently, what's your view?
So domestically, I thought consumption was firm. So I was there about 3 weeks ago. People were spending. Some of the key tourist sites, like in Xi'an, the Terracotta Warriors, was basically several rows behind before you could actually see the soldiers there. But then on the way out, look at Beijing Airport. Just barely any international flights coming out. So that higher ticket consumption items, I think that's a bit more of a problem at this point. Going back to the real estate market, there's close linkages to the financial system in China. Stabilizing the real estate market means stabilizing the financial system, especially the trust and framework, shadow banking, for example. So, that's where I think that they are doing the right thing. But ultimately, how much more downside can you price in, relative pricing? I think it's very limited.
Do you partition China into domestic balance sheet challenges, even out to Chengdu, or do you drag that into the more international analysis of renminbi and the rest? Do you partition or not?
So I think at this point, China's pretty much self-financed. We look at our own flow data. International financing for China's growth is very, very limited right now. So it's about domestic financial stability.
I agree.
And then the transmission is, if things go awry, can that drag down international growth further?
We've got to squeeze this in, Jeff. We're in Europe. There is an EV battle taking place. And to a greater extent, I think the transition to EVs is at the epicenter, the heart of this conversation with UAW and the Detroit 3 at the moment. Are we heading towards just massive tariffs for auto imports in places like Europe?
If you asked me 2 weeks ago, I would have said no, but I think something changed at the Munich Auto Show.
What do you think changed?
I think for the first time in 3 or 4 years, Chinese came back and European manufacturers looked at how far they were behind, not just in terms of cars, battery technology, and realized this is much more pressing than we thought, and you saw the reaction.
German manufacturers are scared of what's coming out of China.
Absolutely. And China saw this in advance. That's why they want to build in Hungary battery factories, and they want to build assembly plants in France as well. But even then, with that kind of cooperative approach, you're seeing the backlash already, and then you're seeing the backlash from Beijing. So this is going to get interesting.
Now, this is only one industry.
Yeah.
But do you think there's broader things at play here that ultimately influence things like flows that contribute to causing foreign exchange?
I think medium to longer term, let's look at the chip industry as well. That's going to feature heavily in terms of flows into Asia, into Europe. But the importance of employment, especially in Germany, and also that Eastern Europe that feeds into the German supply chain.
Poland.
I think this is, and politically speaking, this is absolutely going to be central to Europe.
Jeff, this was fantastic. Great to kick off the week with you here in London. Jeff, you there.
My pleasure.
Of BNY Mellon. Bramo, I'm with Jeff. I think you are too. Something did change on this front in the last couple of weeks.
And we had reports that some of the auto manufacturers in Germany were shocked at how much further ahead they are. Not just that, but have more access to the lithium underpinning this because they own that market. So at a certain point, if you can't compete, you regulate.
Well, it's not just tech, is it? It's not just the supply chains. It's cost.
Exactly.
It's cost.
Yeah.
And that's why I think these negotiations with the Detroit 3 and UAW just get bigger and bigger. When you start seeing 20% getting declined, how do they compete with Chinese EVs?
And this is what they're saying. How are we expected to remain profitable? How do we survive this if we're trying to compete with that? And the UAW said, figure it out, because we don't want to lose our jobs.
Big story for us this week. The other one, of course, it is Bramo's birthday week. With us all week in London, Andrew Balls of PIMCO is coming up in the next hour. Live from London, good morning.
Stellantis said they've offered 21%. What are you expecting out of tomorrow's negotiation with them? That seems forward movement.
We've asked for 40% pay increases, and the reason we asked for 40% pay increases is because in the last 4 years alone, the CEO pay went up 40%.
So 21% is a no-go for you?
It's definitely a no-go, and we've made that very clear to the companies.
Sean Fain, UAW president, speaking on CBS. We're living in a world where 20% wage increases do not get it done. And a difficult moment for the CEOs of Detroit's big three, GM, Ford, Stellantis. Lisa, how do you respond to this? When a CEO pay goes up 40% and they turn around and say, we're offering 20, you say you got 40, why shouldn't we? What does the CEO say?
The CEO says you're going to put us out of business, which is what they're trying to say, which is the reason why Ford came out last week with layoffs at a certain plant that was affected. So at what point does that translate at a time where there are going to be layoffs anyway? And they're trying to get the little power they have remaining before there are some pretty massive changes.
Obvious comeback as a journalist to that question then, TK, is ultimately if 40% pay increases mean you face existential risk, why are you getting one?
Oh, there's almost existential no. It's going to be interesting to see what the auto companies say. What I saw was a preponderance of pseudo-engineering analysis about putting an internal combustion engine together versus an EV. And there's some real stark differences there. There's some very good work on it this weekend. My answer is, so what? This is a cultural statement, which is simply, we sacrificed into your bankruptcies. Good morning, Dearborn. Ford, you didn't go bankrupt. And with that sacrifice, we need to get, what? Some payback? I think that's where we're heading.
Question of the week, Tom. How long a visit will it take to have TK and Bramo pronouncing aluminium correctly? Never mind
well,
petrol
that,
and
but
diesel.
we're still going to do copper
take,
out of
Lisa?
Chicago.
Well, it just depends on a will. I mean, it's not sort of an incapability. It's just aluminum sounds better.
It's not about ability, it's about willingness. OK. Equity futures on the S&P, totally unchanged. We're going nowhere. Looking at the bond market with yields a little bit higher by a single basis point. 434.45, very close to cycle highs. Looking at crude through 91 on WTI. We're talking about new highs for 2023. And a euro weak for 9 consecutive weeks at a close last week. The euro this morning, slightly stronger, Tom, 106.71.
Sterling weaker, too. There just wasn't a bid to sterling off the weekend, Friday through this morning, breaking through 124. And, you know, back at a 124 level right now. But, John, sterling needs a bid, too.
Coming up to the anniversary of the Liz Truss budget here in the United Kingdom.
Getting some press.
Lots of fun and games. Is that why we're here?
No, but you know,
make it up.
It's getting. Look, I got my bow tie tied like.
Did you see what a certain former governor of the Bank of England, Mr. Carney, said?
I saw that.
Some of that,
on the channel.
Yeah, that it was not Singapore on Thames, it was Argentina on the Channel.
I read every word of that.
Yeah,
that was before.
What did you make of that address?
I thought it was very carefully worded.
Okay.
I thought that I read the entire address, and I thought it was a very careful statement. And, you know, they'll move forward in the debate. But even more important, Everton lost to Arsenal. So
you watched that game?
I had to watch it. Governor Carney told me I had to.
Okay, because he's an Everton fan.
Yeah.
So I did not know that,
I
but there we
survived
go.
it, to be honest. Right now, we're going to survive American politics. Gregory Valliere briefs us this morning. Chief U.S. policy strategist at AGF. Greg, in the Washington Post, they talk about 5 ideological factions of the Republican Party. I didn't know that. Do you actually buy the idea, given labor unrest in America, given a possible government shutdown, that Mr. McCarthy's dealing with 5 ideological factions?
Oh, at least. Yeah, it's quite a spectacle right now. He's on really thin ice, Tom. I don't think he can get a deal before the October 1 deadline. So we do have a shutdown. I call it shutdown light because it's not going to be the end of the world. We're not going to kill Social Security and Medicare benefits. But if you want to go to a national park, you're out of luck. And I think the shutdown is going to last for quite a while.
Is there a shutdown in Detroit? What I find stark is the imagery and the great coverage by Bloomberg on this. You know, I see them picketing and there's like 7 people out front. It looks like a lineup at Denny's waiting to get in. I mean, is this like a real strike of labor like you and I remember? Or is it sort of kind of like pretend?
Yeah, it's not like what we remember, that everybody went out and you didn't selectively target factories. But I think there have been some sign of progress. I think Ford has been the most conciliatory. And I think the elephant in the room, obviously, is Joe Biden. I think Biden knows that Michigan has 16 electoral votes. And I think Biden will be influential in the final agreement.
What will that entail? Do we have a sense of what it will take to get it done and what that means for the viability of auto manufacturers that have traditionally added to the GDP and really fostered a lot of strength in the Midwest?
Yeah, I think it will have to be close to 30% in wages. 40%'s out of the question, but I think the number will creep up. They may go back to more like defined pensions. They may have less than a 40-hour work week. It will be generous, and it will add to the perception that wages are sticky for the Federal Reserve. I think sticky wages are going to be around for quite a while.
Does this pressure, just sort of uniting the two ideas, does this pressure lawmakers to try to get a budget deal done just to avoid the extra hit on that front, especially at a time where there might be some agreement on things like border control between the Republicans and Democrats? I
tell you, Lisa, these people are on a different planet from you and me. They are fighting these parochial fights knowing they're going to lose. I mean, it's quite clear that this compromise over the weekend would never make it through the Senate. I'm not even sure it would make it through the House. So we're going to go through this exercise. And sadly, I think this drags on right into the holiday season, maybe after the holiday season, before we get a deal.
Greg, I got to turn the script. Once again, over the weekend, lots of discussion about the president's age. I think all of our listeners and viewers are sort of exhausted by the debate. But I want to know the Valier timeline to where I get an LBJ announcement like March of 1968. You and I were sitting on the couch watching the Bruins lose when that happened. How do we get Joe Biden out to where LBJ was in March of 68?
I don't think he realizes there's a problem. More and more Democrats I talk to, almost all of them, as a matter of fact, say they would like to see Biden step down. Two problems. Number one, he is delusional and he doesn't think there is a problem. Number two, there is no logical successor. That's the problem for the party.
Do the polls scream, Greg, that there's a problem?
Absolutely. I mean, about 70% of Democrats say they would prefer a different nominee. I mean, that I've never seen a gap like that. So you could have more pressure. You know, the other thing, guys, I should mention is that filing deadlines are fast approaching. By late October, early November, it's too late to file. So any talk about some last-minute rescue for the party, I think, is unwarranted.
Greg, before you go, have you heard about that missing F-35? Have you read the story on that?
The missing what?
F-35 fighter jet gone missing.
Yeah, in the Carolinas.
Greg, what on earth is going on? How does the military lose an F-35?
I know, it's quite a story, and I think it's going to get bigger.
Greg Valier of AGF, thank you, sir. If you don't know what I'm talking about, I'll share the Washington Post story with you.
Greg, thanks.
It reads as follows. An advanced F-35 Lightning II jet went down somewhere near Joint Base Charleston on Sunday afternoon. And the pilot ejected safely and was in stable condition, the base said. But the problem is that the responders aren't sure where the plane ended up. Believe it or not, the jet's transponder, which usually helps locate the aircraft, was not working for some reason that we haven't yet determined. So we're sitting here, and somewhere, someplace, there's an F-35 that the military can't find?
It raises questions about whether someone interfered with its signals and then maybe took it somewhere else. Well, I mean, what else can you really start to question where things went?
I would question the moment I saw the news, to John's good point, John, I'm glad you brought it up, the conspiracy theorist people will click in here with a vengeance. You know, there'll be an investigation. Obviously, somebody screwed up big time. That's a piece of hardware.
What blows my mind is that at some point on Sunday, there was an F-35 just sort of flying through the sky on autopilot without a pilot. Like that's
it doesn't make any sense.
That makes no sense at all.
Correct.
It's incredible. Okay, we'll see what happens with that story.
I think it's really interesting, too.
I'm pleased you're on the same page. Madeline Jones of Oaktree is coming up. Before we get there, let's check out the price action for you. Equities on the S&P 500 up by 0.1%, just a little bit higher, and the bond market yields a touch higher as well by a single basis point, 434.25. Huge week for central bank decisions. Wednesday, the Federal Reserve. On Thursday, the Bank of England, right here in the City of London. Then on to Friday, it's the Bank of Japan. Live from London this morning. Good morning. Equity shaping up as follows on the S&P 500, slightly higher, nudging higher by 0.1%. Likewise on the Nasdaq 100, just drifting higher by 0.15, coming off the back of a really mild week of losses on the S&P for a second consecutive week. Into the bond market, hardly talked about but worthy of attention, a 10-year yield very close to cycle highs, 434.25 on a 10-year right now, yields up by a single basis point. The intraday cycle high on a 10-year was back in the summer, late August, Lisa, 436.18. We're not far off, are we?
And how much is this being driven in part by the wages that we keep talking about, this concern that wage price spirals are going to keep boosting inflation, or how much is this driven by something else with budgetary reasons? Either way, it to me is underpinning the tech underperformance and a lot of the questions in markets going forward.
I'm going to go all Neil Dutta on you here from across the pond, and Neil Dutta would say it's probably a burgeoning economic recovery and a real buoyancy to it with some demand function, which just lifts up yields into maybe a higher nominal GDP than anybody imagines.
Do you want to throw crude into that as well? 94 Brent, 91 WTI?
Yeah, I mean, what part of EM? We've got Christian Mela coming up later in the week with J.P. Morgan. To me, that's a key interview here. He's going to reframe EM demand for oil. Granted, it's a shock to see how fast oil's moved. And this morning, I think we saw 94.74 intraday high on Brent crude. That's shocking statistics.
It's amazing to see it, Tom, this close to triple-digit crude at the same time, yields near cycle highs when we were meant to be talking about recession at the end of the year, according to the outlook at the start of the year. I want to finish on foreign exchange. 9 consecutive weeks of dollar strength against a weaker euro. The euro right now 106.72, showing a bit of strength and positive by 0.1%. Standout decision of last week, ECB President Christine Lagarde rocking a hard place, TK, and hiking into it.
Oh yeah, under 107 is where euro is, and we'll have to see how we do. 1 bank, 2 banks, 3 banks this week as well. But the answer is we've got resilient dollar, and Jeffrey, you made clear short term that will continue.
Dollar strength, and maybe, according to Jordan Rochester over in Nomura, we come back down to about 105. 105 on the euro. Under surveillance this morning, TK said it, key week ahead for central banks, starting with the Fed on Wednesday. Traders expecting a pause, while a rate hike from the BOE on Thursday is seen as likely. The BOJ rounding out the week with their decision coming on Friday. Out of those three, Bramo, what stands out for you? Fed, Bank of England, or BOJ?
I think it has to be the Fed and the statement of economic projections in particular. People looking at the dot plot and understanding if they upgrade financial growth
this time around.
Yeah, but do they upgrade their expectations for the economic growth in this country? And then do they just assume inflation can keep disinflating immaculately, or does that raise some serious questions about how far they have to go?
Well, you say, will they upgrade? Are they going to mark to market their forecast?
Okay, same thing.
Basically.
Yes.
Because they got it wrong.
Exactly.
This economy's been so much better than people thought it would be. And based on the incoming data, Tom, we're expecting that GDP revision up, inflation down. It's 2024 that's going to catch my eye.
Yeah,
where do they see 24
absolutely
going? And how much wood is there to chop? How much can you push against those rate cuts that people still expect later next year?
To your point, and Lagarde didn't go all Draghi on us and give us a lot of certitude about 2025. You're not going to get that from Powell. These guys are going to be focused on a massively data-dependent set of meetings into next year.
Pretty sure Lagarde's just desperate to get through 2023 before talking about 2024. The update on UAW, President Sean Fain rejecting a 21% pay increase from Stellantis as the strike against the three major US automakers rolls on. The offer coming in well below the 36% raise the union is seeking, with Fain calling it a, quote, no-go, signalling the union and the automakers remain far apart in negotiations. If you follow the interviews, Lisa, I do find it curious. Is it 40 or is it 36? It dropped from 40 to 36. Then in conversations I've heard in the media, he's still talking about 40.
So I don't really understand, and we don't understand what the line in the sand is and what they're pushing for. Either way, it seems like the Detroit automakers are already paying vastly more than Tesla, for example. They're paying about $66 on average versus $45 on average. And Wells Fargo estimates that if they conceded to all of the demands, that would go up to $136 per hour on average for all of their employees. So that's what we're looking at here.
The final story is just to make people living in Manhattan feel better about themselves. Britain's property market breaking another record, rents growing at the fastest pace in at least a decade, while homeowners pushed up asking prices for the first time in 4 months. Tenants paid 12% more than a year ago, according to data from Hamptons, with the average rent in the UK and Britain now £1,300 per month, the highest on record.
Give us an anecdote, John, of all your contacts, particularly in the Midlands. You know, I don't need the details of family and all that, but Give us a John Farrell anecdote about how people are living this.
I won't share a personal anecdote, but I think we should do the compare and contrast.
Yeah.
It is so different in the UK because of the mortgage market structure.
Yeah.
And Lisa, you and I have talked about this a million times. If you've got a 30-year mortgage in the United States, sit on it, hold on to it. Tease people about it, bully them if you want. I don't know what happens around the dining table. That's what Bramo does to me every single time with their 2% mortgage. But you're going to hold on to it, Lisa, and you're not going to sell.
Right.
In the UK, that dynamic does not exist. So you're going to see that effective rate in the mortgage market in the UK come up much more higher, much more quickly than you're seeing it in the United States at the moment.
And how much does that really sort of fortify some sort of wage price spiral if people are realizing that they cannot live with the same salaries at the same levels? And so it just keeps going up, and it's just this whole kind of, spiral.
So Governor Bailey's got short and fixed non-legs. Is that what we call that?
Well, Bailey's also staring down the barrel of something like 8% wage growth as well.
Yeah.
Inflation dynamics in the UK are very different. What's intriguing about the BOE decision on Thursday is that I see a lot of people are expecting a rate hike. Then I look at the recent communication from the core of the Bank of England. They're not screaming rate hike on Thursday at all. So there's a bit of a divide, I think, between the communication I'm hearing from Threadneedle Street and what the economists here in London are expecting on Thursday.
Yeah. I was having my hot brown water this morning. Kathleen called in.
Okay.
My phone rings. It's Kathleen. Kathleen says, my daughter's going to be on with you today. Can you be sure you pronounce her name right?
Are you going to pronounce it right now?
Madeleine. It's
Madeleine.
not Madeline. It's not
Madeleine.
like Bemelman's Bar or, Madeleine
It's not Maddie,
Kathleen,
it's Madeleine.
Yeah.
Okay.
Kathleen, thank you so much for informing me. Madeleine Jones, good morning.
Thank you so much.
What John just talked about, we talk about it in Cosmic, but you live the non-fixed floating rate market. If you were to speak to your mother or anybody else today, what does your world of floating rate debt at Oaktree do to the people of the United Kingdom, or for that matter, adjusting out over time in the United States?
Well, the floating rate market, so we're mainly talking about loans here, bank loans, which are supplied to single B average quality credit companies. And so these were structures that were put on back 3 years ago, maybe more than that, when floating rate was negative in Europe. And they weren't designed to contemplate the sort of rate hikes we've seen in the environment.
So when they reset, it's, to be clear here, price up and the asset value goes down.
Well, I think it's not as linear as you're making it out to be, because it comes back down to what's the structure of that balance sheet look like, and can that company tolerate that inflection of floating rate underlying rates that we've seen. Some companies can and some companies can't. I think the good news for Europe is that a lot of companies can tolerate it. They have not got debt maturities for some time, so some of them with a fixed rate market won't have to reset their debt. And also, we've had 2 or 3 years of quite shocking environments, not just COVID, but also the Ukraine invasion in Europe. And so companies have been quite conservative with their balance sheets, paying down debt, but not making big acquisitions, not doing shareholder buybacks and dividend payments, becoming a little bit more aware of the fact they've got rising cost of debt that they've got to deal with. So although we do believe there's a cohort in there which is structurally challenged because of the balance sheets they put on years ago, we don't think it's a huge insurmountable problem for the market.
Can we build on that a little bit more, just the difference between the transmission mechanism in the United States and in Europe, given so much is done through the banking channel in Europe compared to, say, the United States? Does that mean the speed, the magnitude of the pass-through from rate hikes into the real economy is different? How does that work?
Well, you're right. On the corporate side, more floating rate corporate debt. So the feedback to the corporate is very quick, but the transmission mechanism to the consumer is still quite slow. And I don't think we've clearly not seen that yet. And I think for managers, you have to decide whether you feel as though, can we rely on that consumer still being robust and the broader economy still feeling isolated from that? Or is that something that's delayed and is coming further down the track and a recession may be just pushed out, a year or so down the path.
But this is sort of a what goes first, a chicken or an egg kind of question, right? When will the transmission effects actually go into the economy for the consumers and then for what we're seeing at corporations? In the meantime, borrowing costs don't seem to have torpedoed corporate models. Why is that? Why have things been so resilient after 10 years of people warning that it would be Armageddon if we got anywhere above zero?
Yeah, well, I think it's partly delayed because the fixed rate part of the high yield bond market, and a lot of companies have a mixture of fixed and floating debt. So they're seeing the immediacy of those floating rate loans impacting them. Some of them hedge that out, so it may not be as clearly impacting today as you might think. But with the fixed rate, they're going to have to wait till the debt matures before they really feel the pressure of that rising rate. And maturities, they aren't that significant this year. Next year, they start to creep up. In 2025, you'll see a much higher rate of need for refinancing at that higher cost.
So as an investor, how do you get in when the going is good? How do you know when there are opportunities, when you're expecting distress to come down the pike in a more material way, when you see the potential for yields to go even higher, but already are able to capture quite a bit of yield relative to where it used to be?
Well, that's the whole job, is to dissect that, and I think the market is pretty good. Frankly, the market's pretty good at that. It's already for quite some time decided which of these company balance sheets are just not sustainable, and these are trading at 70 cents on the dollar, something like that. But it's around 5-6% of the market is down there, and the market's saying that is a structurally impaired balance sheet which will need an equity injection, a restructuring, can't survive in this higher rate environment. But for the rest of the cohort, a large, significant, sizable market is going to be fine and weather the storm. It's just thinner. You have to be very, very careful. Default avoidance is in our DNA. We have to focus on protecting ourselves against default and really stress test that thin layer of cash flow which is left in some of those companies.
Crane's a moment ago in New York, the real estate people published an important article for New York City, which is that old buildings have an uncertain future. I'm going to assume for Oaktree, old buildings with an uncertain future is a huge opportunity. How do you play commercial real estate in London? In Manchester. Manchester's north of London?
Manchester is very much north of London.
How do you play it across the United Kingdom and not in the romantic fancy spots like the skyscrapers around us here? How do you play commercial real estate as an opportunity?
Well, I think that's where you have to have that analytical team that understands the difference in the geographies and markets and what's the supply-demand fundamental looking like within a location. It can vary. The great thing about Europe is that it's so varied across so many different geographies. That makes it very interesting for people like me to find.
Well, where's the city? I mean, nobody's listening. Where's the city that has an opportunity right now?
Well, I think corporate real estate isn't in my wheelhouse. I'm more in the corporate debt market, so cash flows are the predominant mainstay of my investing potential. And you'll find lots of good companies across lots of good markets. Some of the places we've been rowing back from have been traditionally some of the best because they tend to get over-levered.
Name them.
Well, one, I mean, as a geography, when I look at our portfolios, everything is built from one issuer, granular up. It's not taken on a top-down. But when you look at us in a portfolio where we were a year ago, where we are today, somewhere like Germany has become a lot less significant in our portfolio.
Interesting.
Because we found, a lot of industrial Germany was successful because it relied on lower cost of energy. And now that dynamic has changed, and admittedly they did a brilliant job of shoring up that energy shortage crisis we were very worried about. But it is still structurally more expensive, and that challenges the competitive nature of industrial Germany. So for us, we've tailored back down some of our exposure there. It's things like that. It's all built from the bottom up.
Yeah.
You can start to see a picture of where those bets are taking place.
Fascinating. Madeleine, thank you. Madeleine Jones of Oaktree. You want to do a shout out to Madeleine's mum again?
Kathleen, I hope I nailed it.
Okay,
Madeleine.
Okay.
Madeline.
All right. It's Madeleine. All right, cool.
I know Madeleine for the Bellman's Bar.
Are you flirting with Madeleine's mum?
No.
Is that what's happening here? And Rita said,
Kathleen briefed me.
Energy Aspects on $90 crude up next. Should they worry about $90 crude if it's just a supply shock? Should they worry about that?
They should. I mean, otherwise they're going to repeat the same mistakes they made in 2022. In some cases, prices were falling, energy. Services were inflating, but if you wait long enough, services will start to disinflate as well. And the fear was that goods would start inflating. Now we're seeing goods are going to start to inflate. And that's, I suspect, will keep people up.
That was Mohammed Al-Erin of Queen's College, Cambridge, speaking to me on Friday on the impact of higher oil, potentially for the Federal Reserve, which meets on Wednesday. Crude this morning, 91.45. Brent crude having a little sniff of 95. This is stuff we haven't seen, Tom, for all of this year through 2023. And crude is at the heart of everything, I think, right now that we're talking about.
The three of us got together. We almost never see each other, folks, because of the crazy New York schedule. And to have a full English, all three of us, was really something here this morning. And
OK,
John,
let me cut in. Headline. I come downstairs today. TK's having a fruit bowl. It's a fruit bowl.
Yeah.
You were there for it.
Yeah,
I saw it.
There was witnesses.
That was new. What came before the fruit bowl is what I want to know.
The full English.
OK, all right. Good to know, TK.
You nailed it, John. And to me, the lead story this morning for global Wall Street isn't happening. And the bond market is moving. It's fractional. We're all jaded by it. But nevertheless, the levels we're quoting, the real yield, Lisa, you mentioned 1.99. These are substantial numbers. And they change the dialogue of these three Fed meetings, particularly the one we're underplaying at 147 yen, which is Japan, the last one.
I like what Mohammed had to say, that this really speaks to this question of goods disinflation and goods reinflation because of petrol and how it influences everything in terms of getting things from one place to another, and transportation costs as well as production costs.
I'll ask the question that I asked Mohammed of you then, Lisa. Do you think it is something the Fed can ignore on Wednesday?
They can't ignore it. They're going to say it's transitory. But at a certain point, if they start to see goods reinflate, can they say that's transitory too? Can they say that that's manipulative? How can we know if we don't know whether the oil price is higher because of demand or simply because of the supply cuts?
What's the single effect you get from the wage negotiations with UAW and the Detroit 3? TK, I think for a lot of people who have their annual wage negotiations, looking at what's happening in Detroit kind of matters. They want a bigger share of that. Aren't they going to be more emboldened to go and ask for
Lisa was at Teterboro, Middletown, I can't remember which, getting on the Gulf Stream, and she put out that chart on Union, and it's really spiked up. I mean, it's back 10, 15 years to the angst we're seeing now, and I do agree it percolates, maybe is the right word. It percolates, like what the percolation of water you do to make hot brown water.
OK. Do you want to explain what you think hot brown water is? You're calling tea hot brown water?
Well, I was watching. I watched Richmond this weekend. They got relegated, but I watched Richmond, and what was great was walking down the street in West Ham. People were walking by me, like to the
Where did you go?
Ballpark. I was like
to the ballpark.
Yeah, they're going to the ballpark.
We're going to stop this now. Brent crude 94.53, TK WTI 91.54.
Let us move on. Amrita Sen joins us to save us here from the ballpark. Co-founder, head of research at Energy Aspects, and critically joins us this morning from Canada, which is an oil producer. Amrita, within your racket, within your industry, are they looking at this as a surge that can ebb, or is there a feeling, within the macro petroleum business that this is a new pricing to stay?
Well, it's still early. It's not even 5 a.m. here, so I don't know how they're feeling. But if I had to guess, Tom, I would say they are all going to be very happy. I mean, of course, there's World Petroleum Congress over here. Ministers from all around the world are gathering, including Prince Abdulaziz himself. There's lots and lots of talks with both consumers and producer governments really over the next couple of days over here. And I think the reality is that demand has surprised to the upside, regardless of all the recessionary fears that we've seen. Right. And I think that's why what is interesting for me is, yes, crude is getting all the headlines now. We're talking about it. But if you look at products and crack spreads, that have already been high for the last few months. Gasoline, diesel, they've been trading at $120+ per barrel. Crude was 80. Now crude's catching up, but those prices haven't necessarily gone up further. So this is more of a redistribution between refiners and producers than really end users feeling the impact. So I know why the media is focusing on the crude, but I don't think the end user is necessarily seeing that big an impact versus a few months ago.
Right. What is the representation or tone of China is the marginal demand elephant in the room at the Congress? Is China there in a big way?
I think there is going to be presence for sure. And I think, again, the dichotomy between Chinese macro and Chinese oil demand is definitely going to come up, something we've been highlighting for some time now, because in the West, and Western analysts keep looking at the Chinese macro data and saying, well, oil demand hasn't been performing yet. Oil demand has actually been hitting record highs because it's become more consumer oriented. Plus, China's got some strategic petroleum reserve filling going on as well. In some ways, the US has been drawing it down last year, and China now is actually refilling it, having locked in some favorable prices earlier in the year.
What's the pressure on Prince Abdulaziz today, who's going to be speaking, I believe, around 10 a.m. Eastern time at the Calgary conference to really increase production, especially if this is being driven in part by demand, not just their supply cuts?
Well, I think he's been very clear that, look, there still is a lot of uncertainty, be it from the Fed itself or even China, all the kind of noise that's coming around. And he has to be 1,000% confident, I would say, not even 100%, that there are not going to be any of these, surprises with the Fed, for instance. And it's a bit of a chicken and egg, right? If oil prices go up, what does the Fed do, as you guys have been talking about as well? But I think they are going to be cautious. They want to ensure that balances, or at least inventories, do not build because of those macro concerns. And look, Saudi Arabia has extended the cuts till year end. So has Russia. It kind of gives, for them, the main thing they want to provide is stability. And I think that's what he's trying to do. And I think that's what he's going to focus on today.
It's a really interesting confluence of events. At the United Nations, they're holding a conference right now where a lot of the focus is going to be on sustainable energy and moving away from fossil fuels. You have electric vehicles taking over. That is underpinning some of the discussions with the UAW. How much is that underpinning Saudi Arabia's decision to cut production, to get more profits now before some of these groups phase out fossil fuels, before they become less of a focus later on?
Well, you could argue that goes both ways, Lisa, right? I've also heard the argument that that's why other countries want to flood the market and make sure they don't have stranded assets afterwards. I don't think OPEC plus policy works like that. We've written about this as well, that ultimately Saudi Arabia and most OPEC countries are revenue optimizers, right? What they are trying to do for themselves is saying, okay, if this is the price and we cut production or raise production, what is our total revenue going to be? That is what they are focusing on right now. Of course, they are concerned about long-term energy transition, but I wouldn't even use the word concerned. I think they embrace it. They are doing a lot around it. And They very much are aware that oil has to fade over time. They just disagree with the timelines like the IEA has put out.
What's the Amaretta Sen timeline of an oil vector, I guess, in June or July of 70-something up to 94.51 right now? Is that just a continued vector up? Do you see 95, 96, 97, et cetera, et cetera, et cetera?
Yeah, if you remember, Tom, our price forecast for Q4 was an average of $92 for Brent. So I think we've kind of hit it now. So the question is, but look, an average of 92 does allow oil prices to go to 100. We're putting out a piece later today, which is calling for $100 by Halloween for Brent. And again, this is just a trajectory. And at this point, look, of course, it's a short-term thing, right? I'm not saying it's going to average above 100, but could it go to $100 for a bit? Absolutely, yes.
A triple digit by Halloween, Amrita, is that just a marketing mechanism? Just, triple digits, Halloween, or is there something about the next month?
No, it just rhymes, right? 100 by Halloween. That's why. No, I'm joking. But it's just, no, I think, look, fundamentals are very, very strong right now, but also positioning. And that's one thing we shouldn't miss. A lot of hedge funds are very underpositioned in crude because of the macro concerns. Now we are seeing quite a bit of passive money come back as well. So I think the combination of that could actually lead to a temporary kind of upswing in crude. And that's why I'm not saying we're not expecting it to average above 100, but it could go above 100 in the next couple of weeks.
Only $5 away right now. Amrita, thank you. Amrita Sen of Energy Aspects. We'll run with that headline. $100 crude by Halloween, TK. It's just around the corner. It's hardly a call at the moment, is it?
Got to change my outfit for Halloween.
What are you going to wear? A barrel of crude?
Yeah. I don't know, go as a barrel. I like that idea.
We once joked we'd go as QE, TK, QT, and all of that good stuff, and now it's $100 crude.
I don't think this is a small idea. Javier Blas talking about Arab Light already there, and the way he looks at it, I don't understand it, but that's what he said. And
94.51 on Brent. I've just seen him out the corner of my eye. Andrew Balls of Pimco coming up next. Very cool. With us here in the studio, here in London. Live from London this morning. Good morning to you all. With equity futures slightly positive, this is Bloomberg.
We've yet to see the full effects of the previous tightening come through into the real economy.
We have structural imbalances here in the U.S. that no one wants to deal with in Washington.
The bigger concern would be that things get unruly in China.
I think the Fed is going to be paying very close attention to the path of energy prices ahead.
The Fed will do what we all expect it to do, which is to pause and basically indicate they're data dependent.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from London, on the edge of saying good afternoon for our audience worldwide. Good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market on the S&P 500, just a touch positive on the S&P. Got into a massive week for central bank decisions. Wednesday, the Federal Reserve. Thursday, the Bank of England. On Friday, TK, the BOJ, just around the corner.
Translated with $94 oil, up goes a gallon of gas. I know they don't pay attention to that. Somehow I think they will on Wednesday, and I would suggest the governor of the Bank of England, you ready for this? $7.24 for a gallon of petrol in the United Kingdom.
That's real money.
That's real money. I mean, you know, we don't look at that. The cars are smaller. Lots of electric vehicles here, way more than I would perceive in the United States. But I'm sorry, inflation's there. And as you said earlier, John, at our leisurely English breakfast, full English breakfast this morning, it's just real simple. I mean, all in, inflation's a story, higher yields.
Look, this hurts, even with 7 to 8% wage growth in this country at the moment. There's a lot of difficulties here in the UK, just as there are over in the United States right now. Do they get harder? Lisa, at the moment, we're looking to a growth forecast from the Federal Reserve on Wednesday that is set to be revised higher for this year. I've got no idea what 2024 looks like.
Recession coming.
Reflecting that, to some extent, yields near cycle highs, crude near the highest we've seen it for the whole of this year. Bramo, these kind of things, I'm going to borrow your word, percolating and hardly been talked about this morning. I find this bond market move, 434, right by intraday cycle highs, and I don't see a headline anywhere on it at all.
And it's being driven by real yields, which means that the inflation adjuster, the expectation of inflation baked into the market versus the actual yield is the actual yield is the highest going back nearly to 2009. We're bumping up against 2%. At what point is this a statement about some of the wage negotiations on the heels of some of these price increases, pointing to some sort of wage spiral? And at what point is this pointing to some sort of fiscal pushback? And at what point is this just great yield, go get it, because you're not going to get it for very long?
I'm not in the rate of change of a quote-unquote wage spiral and all the emotion and baggage of that from the 1960s, but Andrew Balls is over here next to me. We're going to bring him in a moment. He's nodding his head on real yields. And the key question for me is the benchmark real yield that the pros follow is a 10-year yield. And the answer is the 5-year real yield, to me, has uncommon value. And I'm sorry, it's a melt-up. There's no other way to put it.
We'll return back to that in just a second. Just to give you a flavour of what's happening cross-asset at the moment, futures slightly elevated by 0.1% on the S&P 500. Last week, a very mild week of losses on the S&P for a second consecutive week. In the bond market, yields a single basis point higher at 434.25. And just to finish on the euro, Lisa, 9 weeks of dollar strength against a weaker euro. We're trying to bounce back from that. 106.67 on the euro against the dollar.
The FT did a poll of economists. 40% of them expect more than 2 more rate cuts or two more rate hikes, at least in the next couple of years. Today, we're looking at oil very much front and focus. 10 a.m. we get some words from Saudi Energy Minister Prince Abdulaziz bin Salman speaking to the World Petroleum Congress in Calgary. Curious how he dovetails supply versus demand. How much of the increase in crude really has come from a stronger than people give credit to China and just the rest of the world. Today, sort of in contrast, you hear a lot about electric vehicles and renewable energies at the UN General Assembly, which is a beginning. We're also going to hear from perhaps a discussion with the U.S. and China. More on that later.
Just to say that's why we're here.
What? Because
to avoid this.
100%.
This is like the worst week of the year living in Manhattan. Unger. It's just, I hate it. The traffic everywhere. I wish they'd move it. Yeah. Maybe that's controversial. I don't know. I wish they would move the UN General Assembly
Afterthought schools being shut down this week.
Well, yeah. Honestly, we all had the same thought. How lucky are we that we get to be in line.
Take it to Queens.
Okay.
Meanwhile,
so it is also, of course, celebrating birthday week. We'll have to do this every year. Today, also, we're kicking off a week of monthly housing data. This is when all of the data gets dumped out, including today at 10 a.m. Eastern, the NAHB Housing Market Index. This comes as affordability hits the lowest levels, at least by this measure, in the United States, going back to when this series was created in 1986. This raises a question: what goes first, the price of houses, or do wages just keep going up to respond to this?
That's all the data, the look ahead for today, and a sneak peek of the rest of this week as well. With us around the table, you've got a sneak peek of this. Andrew Balls, Global Fixed Income CIO at PIMCO. Andrew, good morning.
Good to be here. Thanks very much.
10-year, fantastic to be with you. 434 on a 10-year yield this morning. To build on what Lisa said, is this a moment in time? Buy, lock it in before it goes away, or can we live with this?
So I think it looks pretty attractive. We're in the middle of our forum discussions, which we had in London as well, actually. So we're still talking about this with the investment committee.
Give us a head start.
But it looks pretty attractive here. If you have a high-quality bond fund, 5-6% yield in US dollars with more credit, kind of 7%, maybe 7.5% yield, this looks very attractive. Equities have done very well this year. Looking forward, 6.5%, 5.5% type yield for a bond fund looks very good to us.
There are 2 points here. One is, does this look attractive now? And the second is, where is the next rate? Where does the move come from? Is it higher or is it lower? There are two different discussions, right, and how sticky this is going to be. How big is the argument right now in some of these meetings at PIMCO?
Well, I think you were talking about real yields, and I was nodding. When you look at real yields and look at long-term history, it's starting to look attractive. Here we had this period after 2008, quantitative easing and all of that, and depressed real yields. But you're now seeing real yields at attractive levels, and nominal yields I was quoting before look pretty good to us. You have, in the outlook, you have inflation still stubbornly high at the core level, improving much faster in the US compared with Europe. But I think the jury is still out there. But then don't forget the recession risk. We have had very significant global tightening across the world, and yes, the data has been better than expected, particularly in the US this year. But as we all know, these central bank tightening takes time to feed into the real economy. So looking forward, the jury's still out on inflation, but that recession risk remains significant.
Critical question for PIMCO, and it's not only the heritage of PIMCO from Bill and Mohammed forward, the great call you people made a number of years ago. You've got the advantage of the former vice chairman, Richard Clarida, I believe, darkens the door. I can just see Balls and Clarida in a debate over where we're going to reset on our start, and almost on a global R start. Do you sense within all the great work you do, Andrew, that we're going to reset at a new rate regime, something that we've never experienced before?
So I think it's an interesting debate. Rich and I tend to agree and on this point that as you look forward beyond this inflation episode, the cyclical rise in policy rates we've seen, there's good reasons to think that R-star neutral rates are at the low levels that we've seen for the last several years. We'll see this in the Fed's projections this week, but the chances are the Fed will also see 2.5% as their long dot. So compare the 4.5%, 4.3%, 4.4% for the 10-year Treasury, or look at the forward rates and compare it with that neutral anchor. We believe that anchor remains the correct way to do the analysis, and then the long-term outlook versus that then looks very attractive, I'd say.
Does Lagarde have an R star? Does Ueda have an R star? Dare I say, does Bailey have an R star?
They all have their they all have the variations on this. I think the Fed maybe is a bit happier to talk about it sometimes, but again, looking at bond yields now. Even in Japan, you are getting to levels in terms of the 10-year yield where it's starting to look more interesting. Control for volatility, return per unit of volatility.
I agree with that.
And really it becomes a little bit once we get beyond the YCC, once we get beyond the yield curve control. So if you think that you have that anchor, and we do, then look at your five-year forward rates. to isolate the long-term expectations beyond this central bank cycle. And that's the environment when it's much easier to come in and be positive like I am today compared with the lows of the COVID period.
We don't spend nearly enough time talking about this. How different this regime is to the regime of the last decade before the pandemic. How different is it for you and the team? What have you had to change just in terms of approach away from zero rates and QE forever towards potentially the Bank of Japan hiking interest rates, the ECB going to levels I never thought they'd get to? I thought maybe they'd go back to zero, but here we are at 4%. How different is this for you and the team?
Well, I think it's very different, and I think as a bond manager, you like to see these high yields at the front end of the curve. It becomes really interesting, the relative value at the front end of the curve. Zero yields. Remember those. Something that hopefully we've consigned to history. I think one important thing looking forward, different to the last 10 years, is uncertainty around inflation. So we see inflation coming down towards central bank targets, a little bit above, but coming down over the course of next year. But I think clearly there's much more uncertainty in the inflation picture for the next few years compared with the last decade. And so back to the discussion before, you should be getting term premium. You should be getting paid appropriate term premium for holding the 10-year part of the curve. But again, comparing our forward rates with our expectations for our start, it looks like you're getting fair compensation after a period when, with quantitative easing and all, the risk premiums were really compressed.
What about in credit, though? I mean, given the fact that you're looking at greater vulnerability to an oil price shock or a unionization shock or a technological shock, some of these things that become that much more important when your cushion is that much smaller.
So I think the baseline for credit looks fine. I think credit should do well in an environment where you avoid the tails, not just about recession, but real recession, not just a technical recession. And on the upside case, if inflation is coming back into line with that fairly benign middle path, then credit should be fine. From our perspective, though, we want to guard against the tails. And if we do get deeper than expected economic downturn, that's going to be painful in credit. So I think up in quality, IG looks attractive versus high yield. Avoid cuspier credits, avoid any kind of exposure to real default risk in what remains a really uncertain environment. It's not often you have these sorts of tightening cycles globally to such an extent. And then the final thing, there's lots of other stuff we can do in the world. US agency mortgages, very, very high quality instrument, very attractive in terms of the valuation. So again, if you can get to the kind of 5-6% type yields on core bonds, that looks pretty good to us in terms of the next few years.
Andrew, always a privilege. Thank you, sir. Andrew Bulls there of PIMCO. Your bond market, 2-year just north of 5%, 10-year at the moment about 4.34. If you are just tuning in, welcome to the programme. Equity futures on the S&P positive by literally nothing, 0.04% higher. Outside of that, in the foreign exchange market, 106.68 on a euro, positive by 0.1%. Crude, new highs for the year in sight once again, 91.52 on WTI. Andrew Bulls now needs to explain to Tom Keene who Norwich City is. TK, if we're going to do a football tour, you've got to talk to Andrew about Norwich.
Well, they're destined. Are they going to go up or down? I loved watching this weekend. Who played Chelsea?
Who did you watch?
Bournemouth, maybe.
Okay.
Brentwood, I can't remember. I love the little stadiums.
Brentford.
Yeah, there's no American equivalent to how close the people are, like in Norwich.
What's the Norwich Stadium like?
It's great. It's very loud. It's
the
old-fashioned stadiums.
The old-fashioned stadiums.
I go as often as I can without really annoying my wife. But I go to quite a few games.
But there's there's 10 Fenway Parks. Seriously.
Oh yeah. I prefer the older stadiums as well.
It's very cool.
And then the new owners want to come and they want to rebuild things and.
So who are you playing in the
direction.
EFL? Norwich. See how I did that?
That's perfect.
Next one is Leicester. So top of the table clash coming up.
There we go.
Did I do okay there?
I'm proud of you,
Nailed it.
TK. Good stuff. Anne Marie is in New York City for the UN General Assembly.
Leicester.
She's going to be joining us next from London. This is Bloomberg.
I feel we made some good progress this weekend. I want to make sure we don't shut down. I don't think that is a win for the American public, and I definitely believe it will make our hand weaker if we shut down. I've never seen somebody win a shutdown, because when you shut down, you give all your power to the administration.
I can't believe there's another story that I follow less than this one. House Speaker Kevin McCarthy discussing the possibility of a government shutdown on Fox over the weekend. Bramo, so many people that listen to this programme find this subject absolutely tedious, and they start to ignore it. They ignore it, and then it starts to matter. Does this matter?
It seems unlikely that they're going to come up with some kind of proposal based on the fact that the proposals that they have out there aren't going to even pass measure within the own House. Here's the question. When do people start caring enough to possibly get on the same page and get to some agreement? When do people care enough to start putting that into economic projections, considering it does have something of a drag?
How linked is this mess with the impeachment inquiry that was started in the last week or so? Is that the bargaining between House GOP at the moment and the Speaker?
I honestly am not going to come up with rationale, but right now there is a bit of try to cater to the right of the party so that you can get some sort of deal through so that you're not accused of shutting down the government, and that probably is part of the wrangling in the House.
Equities right now on the S&P 500, just about positive to kick off things this Monday morning. Good morning to you all, up by 0.1%, let's call it. Yields just about unchanged on the session, came really close to intraday cycle highs on a 10-year a little bit earlier this morning. 435.45 was the high of the session, high of the cycle 436.18, and in foreign exchange, Tom, 106.69 on the euro, just a little bit stronger here. And if you're wondering where crude is, it's near the highs of the year, 91.40 on WTI.
Well, I'm going to go to $94. A 95 print would be shocking on Brent. We're not there yet, but that gets my attention. John, I'm just riveted with what we heard from Andrew Balls. I mean, I just think the three of us out at Norwich with Lester here on the 20th.
Well, I wasn't aware that Andrew's brother is no longer the chairman of Norwich City. He's since
Josh
taken on a
Sargent
different
hurt
role.
his ankle, the United States player playing for Norwich.
Nice.
And, you know, I
We'll
think
watch him play Leicester.
They're strong. They start 4-1-1.
Okay.
It's a draw, not a tie.
Thanks for that.
Thank you. But it's good to see that from Norwich. Keeping up with Norwich football is Anne-Marie Horton in New York, our Bloomberg UNGA correspondent, and we welcome her to the worst traffic in the world. That would be Midtown Manhattan all this week. Your message, Anne-Marie, away from the follies of Washington, is you're watching the meetings away from the green marble of the United Nations. What meetings really matter?
Well, the meetings that actually really matter this week are the meetings that are not happening at the UN General Assembly. So what we've learned over the weekend is that President Biden's National Security Advisor, Jake Sullivan, met with Wang Yi, of course, Xi Jinping's foreign minister, in Malta. And what those two were talking about, a number of issues, of course, but really the potential for Xi Jinping and President Biden to have a meeting. These two individuals, these leaders, have not met since the G20 in Bali. But obviously, we've seen a number of high-level meetings from counterpart to counterpart taking place in Beijing. This could potentially see Xi Jinping coming to San Francisco, to California for the APAC summit. That meeting took place, and then Wang Yi later this week is going to Moscow, where he'll sit with Sergei Lavrov, who will also be at the UN, but Putin will not be at the UN, Xi Jinping will not be at the UN, Mohammed bin Salman will not be at the United Nations. So I think I want to see what happens between that Wang Yi and Lavrov meeting, which is happening on the heels of Jake Sullivan's Malta trip.
Well, I want you to report right now, Anne-Marie, why is the UN suddenly a non-event? I mean, everybody used to parachute in. I have the memory of being at the Council on Foreign Relations, Lisa, and Muammar Gaddafi walking by me, granted with a security entourage of 14 people, but it used to be a big deal. Why is no one showing up now?
It's still a big deal. For Diplo nerds, this is amazing. You can walk down 3rd, 2nd, 1st Avenue and potentially run into, say, Erdogan. Like these moments have happened, and you get some of these moments where you can see also who they're speaking to, and it's the sideline meetings, of course, that happen alongside the UN. Like President Biden will be sitting down with Benjamin Netanyahu. Interesting enough that this is not even happening at the White House. It's a meeting, a bilat alongside the UN. Obviously, there's been some tensions between Jerusalem and Washington. I'm just saying, in the broader aspect of what is happening in the geopolitical landscape in the world right now, the most important meetings, when you look at Jake Sullivan and Wang Yi in Malta, then Wang Yi going over to Moscow, those meetings are happening outside of New York City.
Yeah. It's like, Lisa, when I talk to Ferro, it's so rare, it's like it's a bilat. when John and I talked to Bilat.
I immediately Googled Diplo Nerds, and there's actually an entire website devoted to games called Diplo Nerds. I am curious, though, Anne-Marie, this idea that the United Nations is losing relevance is something a lot of people have been talking about, which raises a question of where are the forums going to be held, in what kind of space to bring powers together at a time of increasing divergence. Is this something that people are really talking about at this UNGA meeting?
At every UNGA or UN General Assembly meeting, people will cast the fact that is the UN obsolete? And I think the past year and a half has showed just how constrained the UN. I mean, Russia sits on the Security Council of the United Nations. The most they can do is get the General Assembly to condemn Putin's invasion of Ukraine. But can the UN actually do anything to stop this war? No. And that's part of a lot of criticism that the UN gets. But really, it is just a forum to bring individuals together. Another interesting story that will be happening alongside the sidelines of the UN General Assembly, I reported this last week, and the Iranian Foreign Ministry confirmed it this morning. We will be having a prisoner exchange today between Iran and the United States. I've also have reporting that $6 billion of Iranian funds that were held frozen in South Korea have now been delivered as of this morning, about 4 a.m., 5 a.m. Eastern time this morning, have been delivered to Qatari banks. And what our colleague Arsalan is reporting is that potentially there will be some discussions on nuclear program in Iran between intermediaries with the United States and Iran alongside UNGA this week.
Just to follow up on what you were talking about earlier, this idea that one of the most important meetings already took place between Tony Blinken and his Chinese counterpart. Was there any resolution from that? Was this paving the way for some sort of Biden-Xi bilat or something further to really shore up relations?
This Jake Sullivan meeting, I think, really is the preview for the potential Xi Jinping-Biden meeting. These two individuals have that unfettered access to their principles, and they could speak a little bit more candidly than you would see, say, a Gina Raimondo and her and her Chinese counterpart, or Yellen and their counterpart. Jake Sullivan and Wang Yi are the ones that can really set the parameters of this meeting, which the United States has been asking for. And Xi Jinping at the moment is dealing with a difficult economy domestically and also difficult issues within his government. You know, we still have missing Qin Gang, the former Chinese ambassador to the United States, who was the foreign minister. He was the one that should have been sitting with Jake Sullivan, but he has disappeared, and unclear where that individual is right now. And then, of course, Li Shangfu, who U.S. officials believe was removed from his post. This was the head of the military, the defense minister, who they've refused to have a meeting with Lloyd Austin with because of the fact that he was sanctioned by the United States. So you see some movements within the Chinese government. You see concerns domestically with the Chinese economy. Potentially, this is the time Xi Jinping wants to come to the table, and it would be on U.S. soil.
MH, we've got to squeeze this in. How has the U.S. military seemingly lost an F-35 fighter jet?
I do not know. I do not have answers for this. I've been looking to see what the command center is saying. The pilot was able to evacuate, but still this F-35 seems to be missing. I have a lot of questions, as you do.
Amazing story. Amazing story. Anne-Marie, over in New York all week for us for the UN General Assembly, or locally known as UNGA.
I hate it.
I feel sick saying it.
UNGA. Actually, it's really fun to say it repeatedly.
No, I'll take a pass on it.
UNGA. Hooked on a feeling.
Wow. What was that?
It wasn't B.J. Thomas. It was after that. Somebody did a redo of Hooked on a Feeling, and they go, UNGA.
So that's actually a song?
Yeah. It was a big hit. Huge hit for B.J. Thomas.
It's a break, Grandma. I don't know how you feel about that.
I think that it would be really great. I think it would be good. Let's do it.
How'd you lose an F-35?
I don't know. I mean, here's my question. What do they know that they're not saying?
There's always something.
Right. So is this an issue of the weather needs to clear to then go into the lakes or wherever that they think that there could have been some sort of accident? Was this something about the transmission system and what could have gotten hooked in? I don't know.
So was it on autopilot still with fuel?
I don't know the details.
Oh, okay.
I don't understand. We don't even know why he ejected the pilot.
Pretty fascinating story.
It is.
Isn't it? Catherine Neese of PGIM Fixed Income is coming up shortly as we kick off a trading week full of central bank decisions. Equity futures totally unchanged on the S&P 500. Live from London, this is Bloomberg. Coming off the back of a very mild week of losses on the S&P 500, trying to bounce back, but no sign of a bounce currently. Unchanged on the S&P 500. Likewise on the Nasdaq 100, down by about 0.06%. No drama this morning. The week really begins on Wednesday. We'll talk a lot about those central bank decisions throughout this morning and, of course, through the week. In the bond market, 2-year, 10-year, 30-year, just to slice up the yield curve as we often do across those three maturities. Your 10-year yield came very, very close to a cycle high a little bit earlier this morning, within a basis point of it. This morning, we're now just about unchanged at 433.85, but still here, Lisa, in the 440s on a 30-year. Still there.
We were supposed to be down to 3.5%, according to some. We were supposed to be already talking about recession in the U.S. Instead, we're talking about the ongoing potential for a wage spiral. We're talking about ongoing upgrades to economic growth. And we're talking about a 10-year Treasury yield that is closest to the highest levels back to 2007, raising real questions what the Fed is going to do on Wednesday in terms of
climbing
projections.
for 3 consecutive sessions. Just building on some of the moves we've seen recently going into the Fed on Wednesday. Lisa, I want to finish on foreign exchange. Just get to the euro quickly. It's been 9 weeks of dollar strength against the weaker euro. And those numbers just tell the story, don't they, Bramo? 106.66 for the ECB.
Is this driven by U.S. strength or European weakness or both? And so how do you get the dollar really dictating what we hear, not just from the Bank of England and the Bank of Japan this week, but also the Bank of Sweden and Turkey and everyone else who's going to be reporting?
I think we really focus correctly on bonds, but I really want to state here something we haven't stated. The resiliency of the equity markets is shocking. If you gave me the news flow, including U.S. government shutdown right now, I suggest we'd pop down 8%, even 12% on equity markets as a guesstimate, and it hasn't happened.
So question of the moment. I'm going to go back to it, and forgive me if you've heard this a million times because I'm on repeat on this point at the moment. Reflection of the extension of the cycle or a recipe to end it? Crude in the 90s, bond yields back to 430-something, 2-year at 5. Which one is it?
It depends on what's driving it, especially with crude, given the fact that if you look at it on an inflation-adjusted basis, it doesn't look so bad relative to recent history in the U.S. When it comes to rates, is that being driven by healthy inflation or unhealthy inflation on the heels of some of those crude moves?
Top stories this morning. Under surveillance, the Fed set to make its next rate decision on Wednesday. Investors betting the FOMC will hold rates at a 22-year high. Meanwhile, in the labour market, they've got to talk about this. The UAW rejecting a 21% pay raise from Stellantis. Negotiations between the UAW and automakers will resume today. If 20% doesn't get it done, I spoke to David Welch about this about 2 weeks ago, going into the deadline, and I said, what do you think gets it done? That's our Detroit reporter, incredibly well connected. He thought 20% around that kind of level would get it done. 21% isn't getting it done.
So what does it have to be, and what does it do to the Detroit auto manufacturers at a time of incredible competition? Or even
Who says it's just
Europeans?
about the pay? It's about the other themes as well.
Totally agree.
32-hour
Yeah,
work
sure.
week.
It's super nuanced.
And the whole EV dynamic is interesting me more and more. They want union electric vehicle jobs. And Mari Barr is basically saying no, right?
Well, Tesla's rubbing its hands together, Tom, because they don't have to face that problem. Europe is facing the consequences of underinvesting in the continent for a long, long time and being behind this race. Behind, and Lisa, ultimately, it means perhaps competing with Chinese manufacturers that do this at a much, much lower cost. And as we mentioned in the previous hour, Jeff Yu of BNY Mellon said it, something changed in Europe over the last couple of weeks just on this front. It feels like the EU aren't going to tolerate that competition. They won't allow it.
Because they understand how much ahead China is when it comes to that. But from a worker's perspective, how much are they getting in to try to affect how some of these technological changes affect their jobs before it's too late?
Let's turn to this story. Speaker of the House, Kevin McCarthy, outlining demands to avoid a government shutdown. McCarthy calling for an 8% spending cut to domestic agencies and for work to resume on a border wall. The House expecting to vote on the measure on Thursday. Tom, we're doing this all over again.
We're doing it over again. I love what the Washington Post had this morning, where there's 5 ideological cohorts of the Republican Party. My basic idea is even the least sophisticated people know an 8% budget cut, either, I assume, nominal, maybe they even mean real. It's just foolishness. It's like, why waste our time of all political persuasions doing that?
This is not popular with voters. Let's just put that. Nobody really likes seeing government shutdowns. How divorced is Washington getting, frankly, from voters, whether it's on the Republican side with government shutdowns or whether it's on the Democratic side in terms of Biden and the viability of his candidacy? And it raises this question, at what point will political dismay at a potential government shutdown actually mean anything in D.C.?
Let's finish on the commodity market. We've talked lots about the economic perspective of this, but let's talk about the politics of oil pushing closer to $95 a barrel after a 3-week rally. The surge boosted by higher demand and continued supply cuts from Saudi Arabia and Russia. The Saudi energy minister, as Lisa has pointed out all morning, is set to speak a little bit later on today at 10 a.m. Eastern time. Energy costs putting pressure on businesses, consumers, central banks, and arguably maybe even putting pressure on this White House, TK, going into an important 12 months of campaigning.
It's a sustain of it. What my attention here is I don't see people going up and back down again. I don't hear many people saying we're going to wander back to $85 a barrel. I just, which frankly is still high for people.
Do you have to bake that into forecasts for next year over at the Federal Reserve?
It's a loaded question because they have this foolishness of core inflation. I'm really old school on this. I put much less weight, and a lot of respected people disagree with me on this. They think a core analysis is valid. I'm with Larry Kudlow, ex-Bear Stearns over at Fox now. I just don't buy for a minute the core analysis.
TK crude getting close to 95.
Yeah, $95 a barrel. We're going to see how it folds into the global markets and, of course, into the dollar. A student of that is Marvin Barth. He's founder of Thematic Markets and does a wonderful cross-asset analysis right now. Let's just start with basics, dollar 101. Surprising resiliency in the dollar. Does it sustain?
Yeah, I think we are in the midst of an unheralded dollar cycle like you've never seen one before. This was actually the first piece of research I turned out at Thematic Markets. It's about what's driving dollar cycles. I go back and look through time at what drives these big, huge, previously 17-year cycles. And what it seems to relate to is innovation cycles that come out of the U.S. and drive CapEx cycles. And until the CapEx cycle finishes, the dollar doesn't finish. We're not done with the CapEx cycle.
I mean, John, you thought Chief paid for the Washington Capitals. He doesn't. So if you believe in a Chief cycle and you're going to tie it into innovation, that screams to me American excellence. Is that overplayed?
I don't think it is. I think there's actually a couple different things here going on. One of the things that's very different from this dollar cycle from past ones is the shortness of the investment cycle. So as we are seeing every day, the technology cycle is getting shorter and shorter and shorter. So the U.S. is still running ahead of everybody in a way it didn't in those previous cycles. The second is, take a look at the data. U.S. per capita incomes left Europe behind in 1990 and have never looked back. There's no convergence anymore. And now it's starting to happen versus emerging markets.
What's interesting here, John, is your investment cycle on your ARM shares was what? 2.5 days?
You're going to get me in trouble. Just for the record, no ARM shares at all, none at all. Okay? Are we done with that?
We're done with that.
Okay, good.
Move it forward. There is this question, though, about what this means in terms of central bank policy, or if that's not relevant, because people here are expecting the ECB to be dealing with a more intractable wage spiral and inflation problem than the one in the U.S. And that's going to leave a tighter ECB policy, all things considered, for longer than in the U.S. Are you saying that that really doesn't feature in here in terms of the dollar cycle?
Oh, I think it absolutely does. But remember, I think one of the key things people forget is central banks don't actually set rates. They respond to the economy. It's, if you look at the Fed's forecast, they didn't tell you they were going to go this high. They had to because the economy told them to. All the things you were highlighting earlier about the mystery about why the economy is doing so much better than expected, why earnings and the equity market is doing so much better than expected. This is all a technology cycle. They have to respond.
If that thesis holds true, then wouldn't the Chinese yuan be doing better than it currently is, considering the innovation cycle around electric vehicles and how underestimated that has been based on the recent reaction from German auto manufacturers?
So, Lisa, this is a great question, and I think it's one of the things that if I go back to some of my previous research, I got wrong early on. I thought it was all about the tech companies. It's not. It's about something called localization. If you look in the data, it's not geopolitics or COVID or any of that. Those accelerated it. That has been driving the move away from globalization. It's been localization of production that's been enabled by technology. Nobody's doing that better right now than the U.S. That's what's driving this.
Haven't we also proven that preventing conflict through trade has totally failed?
Well, you can go back to World War I. Who were the two largest trading partners of each other? The UK and Germany. This is a failed concept. I don't understand why people thought it was going to work this time, but it doesn't.
Where does that leave China?
Well, China has its own set of problems, right? So China pursued this massive industrialization policy through subsidizing capital, repressing consumption. The same thing that many of its East Asian predecessors did. It's just done it on a much grander scale. But it now is going to have to pay the price. Fortunately for China, it's the creditor to itself. So like Japan, you're not going to have a global financial crisis type thing. You're just going to have a lost decade or so.
Which is the reason why, and John asked me this question earlier this morning, what's the most important meeting this week? The Fed, the Bank of England, or the Bank of Japan?
So I do think the Bank of Japan is really the most interesting one. The Fed, they are finally caught up with the curve. Yeah. That doesn't mean that they're at the end, but they actually have a chance to pause. And so it's a toss-up there. But the Bank of Japan is actually potentially changing course.
I love the big picture you're taking. I'm going to go back to a podcast David Merritt did with Mariana Mazzucato. He's one of my favorite people here on economic history. Are we at a junction here, as Mazzucato would say, where there is a new, where leadership, like at the UN, can actually piece together a new world? Or is it going to be a Marvin Barsh slog here forward?
So, one of the things I've highlighted about this theme of localization is that this is actually wholly new in human history. We actually have records going back 300,000 years, before actual Homo sapiens existed, of increasing levels of trade among hominids. As you know, it's all David Ricardo's specialization of labor, right? What changes that? When I can substitute a machine for all different variants of human activity, intellectual and physical, why do I need to use the cheapest labor anywhere in the world to trade with that specialized labor?
Do I need a new iPhone? That's what I want. I just want to know, Marvin, do I need a new iPhone? Going back to Ricardo.
Yes, because they're limiting your memory and speed.
They are. Thank you. It's all nanometers, 3 nanometers.
We'll leave that there. Marvin Barth there of Thematic Markets. If you are just tuning in,
can you come back tomorrow?
Of course.
Equity futures on the S&P, just negative here, rolling over in the last 10 minutes or so. We're down by 0.14%. In the next hour, don't miss this conversation with Jules Moak of AXA Investment Managers. The lineup of guests already this morning, absolutely fantastic. Some of the headlines: triple-digit crude by Halloween was the call from Amrita Sen.
Yeah,
over at
this
Energy
is real.
Aspects. We're not far away. Andrew Balls of PIMCO talking up buying duration like right now. Thinks this is a moment in time you don't want to miss. Tom with a 10-year in the 430s.
And Gilles Moak, for Global Wall Street, this is must listen with Gilles Moak of AXA, because he's going to fold into the post-Lagarde ECB world. I mean, some of those headlines were shocking here, and you just wonder, you know, on the gloom basis, where's Germany 6 months from now? But it's much more the holistic view of Europe as a struggle.
And a question, Tom, that you've asked, which is on a gloom basis, why have stocks been so resilient to where we are in terms of real yields, in terms of yields, in terms of oil prices? We're looking at a market that is not what anyone expected it would be 6 months ago, 3 months ago, 3 weeks ago.
Do we have to go to break here? I mean, is it commercial free in England?
In about 30 seconds, TK.
Okay, damn.
You've got a bit of time if you want.
No, but I just think Larry McDonald was great about this. There's a wall of money out there that's got to go somewhere. That's all there is to it.
It's gone into the equity market so far this year. Equity futures on the S&P negative by 0.2%. Coming up next on this programme, Catherine Nice of PGIM Fixed Income. That conversation just around the corner. A triple header of central bank decisions this week. The Federal Reserve Wednesday, Bank of England on Thursday, BOJ coming up on Friday. Live from London, good morning.
I think that the markets are still thinking the inflation is going to drop towards 2%, and therefore the Fed is going to cut rate and cut them aggressively. The Fed is pushing back against that view. They're saying we're going to be essentially higher for longer, not just the Fed, but other central banks. There are structural forces that imply that inflation may be higher. I think markets are still a little bit too optimistic that the Fed is going to aggressively cut rates starting early next year. That's not going to be the case.
Nuria Rabini, Associate CEO of Macro Associates, Rabini Macro Associates, speaking early today on Bloomberg Brief, a news show with Manus Cranny and Danny Berger out of London and New York, respectively. Catch that at 5 a.m. Eastern Time. Just to get you up to speed on some of the price action, equity futures just slightly negative on the S&P. We're down by 0.16% on the S&P 500. In the bond market, we are totally unchanged at 433.65. It is absolutely fascinating to see developments over the last month, to see yields get very close to cycle highs again on a 10-year within a basis point this morning. And in the commodity market, to have crude back in the 90s, not just on Brent, but also on WTI, 91.25 on WTI, up by 0.5%, and a conversation about maybe $100 Brent by the end of October. TK, that's quite a surprise. It's quite a surprise to see that, given where we were back in the summer. I think it's actually a move of something like 35% on WTI since June.
Yeah, I think I took it off June or August, and it was a 30% move, and annualized out, I believe, 248%. Granted, that's a baloney number, but the fact is, here we are. And, you know, we pride ourselves here with Will Kennedy's desk on hydrocarbons, actually based out of Queen Victoria Street. And, John, you look at the Bloomberg News hydrocarbons analysis and all the experts. How many people do we see saying, we're going back to $70 in oil? I don't see it.
Well, what I hear and what I see is basically what you will see. Lisa, you blame Saudi. You blame Russia. This is not about demand, it's about supply. But at some point, you've got to ask the demand question. It's pretty phenomenal. Demand holds up in the face of it.
Yeah.
Given everyone's talking about recession, slowdowns in China, and problems in Europe.
The only person who is calling for prices to come down that I'm seeing right now is Ed Morris of Citigroup, who put out a note. And he was the one who actually got it most right this year. And he said the swing factor here is supply. And you've pointed to this, John. The U.S. is producing a record amount of crude. If they continue to do so, that could potentially change the scenario.
Near 13 million barrels a day. The latest figures on that, 12.9 million barrels a day in America. I was reflected on this in the last week. We've talked so much about the anti-fossil fuel stance coming out of this White House. Does it make a difference if we're pushing 13 million barrels a day, regardless?
That's a good question. And do you sort of see a difference in the actions of the White House versus some of the rhetoric?
One of the great things in economics is every region, every school has a specialty. British Columbia owns econometrics, like really, really extraordinary. She's out of the University of British Columbia. Catherine Nice joins us now, Chief European Economist for PGIM. She gets to tell bond portfolio managers who tell her she's smarter than they are what actually is going on. And she joins us this morning. Thank you so much for joining. I want to go to the right-hand side, rather, of the algebraic equations you're expert at, the epsilon. What's the level of uncertainty right now? Do you have a conviction, or is there such a jumble out there that your uncertainty is just off the chart?
I think what is going on uncertainty is looking very different to the world that we got used to in the decade before the pandemic. And I think that is particularly the case if you look at long-term, where we think long-term nominal yields are going. We were in a world where effectively central banks were promising to buy, and we saw a lot of risk premium compression. We saw very low stable inflation with very little variation around that, very little volatility. That led to further compression into the risk premium. And in terms of the real economy, we weren't really seeing huge real side shocks. And on all of those fronts now, things look to have turned. And so I think this question about where is uncertainty taking us in terms of market pricing is a really relevant question.
I mean, I totally take your point. I've talked about it many different times on a simplistic Hicksian basis. Everybody's in the financial world, and you're overlooking at the real economy impacts of this new interest rate structure. Does that put a dampening on global GDP as the IMF calls for?
I think it really depends on where you look. The U.S. economy is showing real resilience. You've got a substantial amount of fiscal spending. I'm hearing about Inflation Reduction Act, obviously through, the European lens. That's where my focus is, on the euro area economy. And policymakers in Europe are really, hyperventilating about this Inflation Reduction Act. They're very concerned about the negative spillover effects of that for Europe. Whereas if you look at Europe economic activity, it is already slowing. That is not something that is as yet on the horizon. It is already looking quite weak. And so, the prospects for the real side of the economy, I think, is the potential is there for a divergence between what we're seeing in the U.S. and the euro area.
Which is the reason why people are talking stagflation in Europe and they're not using the S word in the U.S. How long can Europe stay in a stagflation type of environment?
Potentially, how long is a piece of string? I think potentially this could persist for quite some time. If I just think back to the experience of the UK, the UK is obviously small open economy. Euro area is a large open economy. It's quite different. We experienced here in the UK a very large series of large relative price shocks that meant that inflation deviated from the target for almost 4 years. And this happened against a backdrop of very little sign of pay growth picking up, certainly not to levels that were inconsistent with the target, a recovering but tepid real economy. And it took 4 years for inflation to get back to target. So that to me already suggests that these shocks will take some time to work their way through. And if we get more such upside shocks like what we're seeing with energy prices, the potential is that this does get drawn out.
So what is the monetary policy response? Is this even relevant at this point at these levels? If this is something else, if this is being driven by other features that aren't related to growth and aren't related to what the central bank can control?
It makes it a lot harder for the policymaker, for sure. But, my view, and this is a debate, I think, to be had with Bank of Japan framework review, potential of a Fed framework review down the line, is the flexible inflation targeting regime flexible enough that it can account for this? My view is perhaps one area that we haven't explored is around the horizon over which policymakers get inflation back to target. So built into that framework is an understanding that if an economy gets hit by a very large relative price shock, the policymaker should look through that, and it might take longer for inflation to get back to target. That was the message we were hearing from central banks when inflation was undershooting, and maybe there's going to be more of that messaging when inflation looks like it's overshooting, on the proviso that we don't see these second round effects crystallize.
Let's finish there then. If we took the clock back to the late 80s and caught up with that gang over in New Zealand and said, what should the inflation target be? Would they come up with something closer to 4 for the period we're in right now?
There are no strong and compelling economic arguments to have an inflation target at 2. If you were starting from a blank sheet of paper, I think 3 or 4 is probably, an equally, if not more sensible place to be. The problem is that, we are not starting with a blank sheet of paper.
Sure.
And my view is that it's going to be a very difficult thing to change. If it's not a good idea to change it when inflation is below the target, if it's not a good idea to change it when it's above the target, then it seems a bit odd to change it when you're at target. And so I think, to me, that tells us we are where we are, but maybe we need to think through other elements of the framework, like the horizon over which we get inflation back to target, and maybe the measure of inflation itself. Is it really accurately reflecting what people are spending their money on?
Well, most people feel like no, and have done for a long, long time. Isn't that a really sophisticated way of saying, just push it out? Just basically just say, we can't hit it now, we probably can't hit it over 2 years, so let's just adjust the time horizon, which is basically just saying, let's tolerate a higher inflation number, isn't it?
For a period of time, yes.
Okay.
And as I say, that's always been part of the framework. It hasn't really needed to have been utilized because we haven't really been hit with these kinds of upside real shocks.
This is what's so important about the IMF projection and the shock of going out to 2028. Who's doing that? Nobody's doing it. Nobody's looking out as Catherine is over a longer time frame. She's talking, you know, she's not saying the x-axis we're going to move out. It's a bunch of fancy language, but the answer is, as you say, it's longer.
We said it this morning, I think, for President Lagarde over at the ECB, just wants to get through 2023, never mind thinking about 2027. Catherine Nice of PGIM Fixed Income is coming up. Catherine Nice, thank you, rather.
Nailed it, John.
Coming up,
Nailed
Sophie Lund-Yates of Hargreaves Lansdown is joining us very shortly. Catherine Nice of PGIM Fixed Income, thank you. Equity futures on the S&P 500, negative by 0.2%. Live from London, good morning to you all.
I think we may very well be at the end of rate hikes.
Most central banks, I think, are probably done hiking now.
The double-digit losses of last year are clearly behind us.
I think the S&P is going to 4,800 by the end of the year.
We actually may see higher than 2% GDP growth on a 5-year time horizon.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene from London. Our studios at Queen Victoria Street on Bloomberg Radio, Bloomberg Television. We've been looking at bonds, equities, the rest of it. John, it's time to look at the equity markets.
You want to look at the equity market right now?
Not right now, but we'll look at it as we go forward.
What kind of leading was that? Okay.
All right, the S&P
I'll do that right
is
now.
down by
The S&P, Tom.
0.2%.
Futures, slightly negative on the S&P 500. It's time to look at that. It's time to look at central bank decisions through the week, TK. Wednesday, we've got to talk about the Federal Reserve. Thursday, the Bank of England. Friday, the BOJ.
But it's such a good, a good feeling. Greenspan had a good feeling about the equity markets and the backdrop to real concern over oil near $95 a barrel. You mentioned the rates popping up today, price down, yields ever higher. There is that good feeling of a market that's been resilient.
Look, TK, I'm with you. This was the dream. This is the dream.
Yeah, for
the
Jerome
Fed's about to
Powell.
market on Wednesday. It's going to upgrade its growth forecast and downgrade its inflation forecast in the minds of most people we speak to. At the same time, got an equity market that's seeing double-digit gains on the year. And we're doing this with yields at 5% on a 2-year, 430-something on a 10-year, and crude in the 90s. If that can stick, I don't know. But where we are right now is what people were praying for at the start of the year.
In the back of this is a social aspect, not only the UAW strike, and Lisa put out a chart earlier this week, was the boom in striking, but John, the very fabric of this nation's being tested with the NHS junior doctors strike. I was shocked at the impact of the residents and interns walking out of the hospitals in the United Kingdom.
The United States is getting a flavour of what we've been living in the UK now for the best part of 12, 18 months. And that flavour is hurting these automakers. If they have to cough up more than 20%, and based on what we've heard from the UAW, it's going to have to be much more than 20%. Stellantis have offered 21. UAW have said no thank you. That's not where a lot of people thought we would be a couple of weeks ago. David Welch, who we'll catch up with in about 10 minutes, Tom, thought 20% would get it done. I understand there's lots of other stories outside of just the wage piece of this, Tom. But to see 21% batted away the way it was by UAW tells you that there's going to be some problems on the horizon for Detroit's Big Three if they want to compete with the likes of China. Now, whether they'll be able to compete with the likes of China is one thing. Whether the US will just turn around and allow these Chinese competitors to come into the US market is another thing altogether. Because based on what's happening here in Europe, the real prospect of much, much bigger tariffs to insulate this economy and German manufacturers from low-cost competition coming from elsewhere.
Well, you see it with the German automakers as well. Lisa, I think you nailed this. I bust your chops about wage spiral, but that's what the fear is you do get into some form of embedded, maybe not a spiral, but a wage up, and that makes it tough for Jerome Powell.
That paired with oil really challenges this idea of a soft landing. It really challenges the idea that we can remain in Goldilocks for a prolonged period of time. It challenges immaculate disinflation. How do you get immaculate disinflation with increasing union actions and really wage negotiations, not just in the U.S., but around the world?
First thing I looked at today, 10-year real yield. John, help me here. I'm going to round it up to 2%. We made 1.99. 2% sounds fancier, but there it is, real yields elevated.
So let me get this straight. You go across the pond and you're not wearing a jacket. Tom wasn't wearing his glasses, and Lisa is still a bear. 1 out of 3 ain't bad. That was the latest feedback this morning. I just saw that pop up on my screen on the Bloomberg. Equity futures on the S&P 500 negative here by 0.1%. Yields up a single basis point, 434.25. Jackets off because the aircon in Europe's just not that great. I mean, it really isn't.
It is.
It's
just not the systems like
just not. It's not like U.S. aircom, which is just like super powerful.
Absolutely. You know, you go in the U.S. You walk down a sidewalk on Lexington Avenue, and there's a store with the doors open.
It's like Arctic freeze comes out.
There's none of that here.
We're getting more European. I will just say that. We are getting more European.
On some fronts, that's a good thing. On the aircon front, I don't think that's a good thing at all.
I'm going to quote you on that.
I don't have the number in my head. John, a gallon of gasoline for all the little itty-bitty cars here and the many electric cars.
In dollars, north of $7.
$7.24.41. I can't remember what it was.
That's brutal.
So it's a whole new...
A lot of that's taxes.
Did we do a data check yet?
We did. I did that briefly.
Okay, you did that data check. Okay, well, we welcome... It's going to be a great week here in London. Lots of really good guests to come up. And we have a credit conference we're doing. When are we doing this? Is it Thursday?
We do that on Thursday, Tom, with Apollo's Jim Zelter.
And it was great when we started talking about it, and it's now even greater, because I would say credit is really front and center.
And the compare and contrast between Europe's experience and America's experience.
Yeah. Well, we'll do that Thursday, and there's a modest Fed meeting there on Wednesday. We'll have complete coverage for you on that. Now, in the equity market, Sophie Lund-Yates joins us now. Excuse me, lead equity analyst Hargreaves Lansdowne. Excuse me, I'm gasping. It's the hot brown water. It's killing me. Sophie, I look at the equity markets, and everyone's flabbergasted at how resilient they've been. Let's start with that. Why is there a bid to global equities as a general statement?
Yeah, this is the big one, because I'm absolutely someone who's in the camp who I'm a little bit of a bear here. I think that
I should be sitting over with Lisa, but continue.
I've still got my jacket on as well. Is that okay?
That's okay. I have my jacket on.
All right.
There's no rules here, Sophie. Just make it up as you
That's not the vibe that I'm getting. I feel like there are some rules. But jackets aside, in terms of what we're seeing, there is a great deal of optimism, and I think that's kind of what you're alluding to here. And I think that unfortunately, that isn't going anywhere. What we're seeing is consumers in particular. They aren't behaving like there is a recession in any form coming around the corner, particularly when we look at the UK, Europe as well to a certain degree. There's a great deal of resilience still in the consumer, and everybody's just very excited. I think there's also a great deal of this notion that central banks are going to be sticking to the script, and that interest rates are going to be doing exactly what everybody predicts it to be happening. And unfortunately, as we know, that's not necessarily going to be how this plays out. So I do think there's potentially some overexcitement in the markets.
What does it mean to be a bear in equity land, as bears have gotten beaten up all year long again and again and are now throwing in the towel?
Are we throwing in the towel? I mean, I'm on the cusp. I think for me, what I want to really kind of just shout about, and I think is getting forgotten here, and I know it's boring and it's not what people want to hear, but let's not forget fundamentals. There are so many people out there, they are talking about incredible thematics and mega trends, but fundamentals to me are where people need to be landing as well. I'm talking about looking at consumer staples, non-discretionary spend. Where is that being funneled in the next few months in particular? I don't want to bring it up, but we are heading into the festive trading season. This is going to tell us so much about where strength lies as well. So for me, it's please remember about your fundamentals, because I think they're getting left by the wayside.
Speaking of fundamentals and pairing it with this idea of the latest tech thing, there was a huge boost to European markets with the idea of a weight loss drug and what it did to Novo Nordisk and the whole question around Ozempic. And suddenly people were talking about how this is going to rejigger the European markets, because suddenly this is going to be the preeminent type of trade. We were talking yesterday about some of the side effects increasingly of this. How do you get ahead of fads that are perhaps bigger in name than they are in reality?
Precisely. It comes back, first of all, to fundamentals. So when we look at big pharma, for example, we know for a fact that you're looking at hundreds of millions of dollars of falling off that patent cliff in the next decade or so. And obesity treatment is a really exciting mega trend. It's something that is going to generate a great deal of money. It's I think a really good place to be. But in terms of getting ahead of that trend and making sure it's not just a fad, you need to also look at what else these companies have on their books. What does R&D look like? What is the pipeline? Because if their pipeline is only this, that's problematic to me. What else do they have that can back this up? But as a megatrend, I do actually think obesity treatment and the drugs there, a lot of that excitement, takes a lot for me to say this, a lot of that excitement is warranted, but it's not enough on its own.
Sophie, how investable are car makers right now?
So I think there's a lot of strength in the sector still. Do I think it's going to be bumpy? Yes, I do. But I think there is some strength there, not everywhere. This is not a sector that is created equal, and the divides here are becoming much, much larger. And I think so much of it, perhaps unsurprisingly, is going to come down to this pricing pressure as well.
So 20% plus makes US autos, GM, Ford, Stellantis uninvestable for you?
It's borderline. I think for me, a lot of that, the problems and the risk probably does outweigh for me. A lot of the excitement is probably where I'm at. But when we look at some of the maybe more exciting names in the sector, I think there are still quite a lot of opportunity. But also this industrial action that we're seeing as well has a lot of read across as well for broader equity inputs as well. So people that are supplying car parts, those areas of the market too. These are really quite vulnerable right now.
Help us with your savings and resilience index. It's acclaimed. Bring that to the UK, but also over to the United States. It sounds so, talking points of consultants. Tell me about our savings and our resilience, given what we're going through.
Yeah, so here in the UK in particular, you mean kind of the savings rates that we came into the pandemic with. So the UK in particular, we had a far higher savings rate than a lot of our peers in particular, and this means that it's kind of feeding into our inflation problem in a really big way here, because we're only just starting to chip away at that. Whereas over in the US, those that kind of resilience and those savings levels have already been depleted. So that's also kind of feeding into things and pulling things down in the trajectory that you would hope for, and that is not playing across in the UK right now.
Sophie, this was great. Sophie Lund-Yates there of Hargreaves Lansdown. Thank you. Thank you very much. Did you see no business attire on the Senate floor? Did you see that new one?
No, I missed it.
They've got rid of the rules. You can wear what you like.
Really?
Yeah, on the Senate floor.
Let me guess. You have thoughts?
I have strong thoughts.
Yes.
I'm sure you have
I'm
strong
shocked.
thoughts too.
They're right.
What?
If you're leading a country, if you're representing the people, shouldn't you dress for it?
So in other words, no sneakers, or I should say no trainers.
Those hybrid things that senators have started to wear anyway with suits.
What if they've got bad feet? I mean, 1 in 5 are over 70.
What did you have to do at school? You got a doctor's note if you had bad feet and had to wear sneakers. That's what I did at school.
So you think that they've got to get a doctor's note if they want to wear the hybrids?
Get a doctor's note if you want to wear the hybrids.
That's fantastic.
You're representing the people, the country. If school kids have to do it, why shouldn't they?
So you think they should have a uniform?
They should wear a business suit if they're a male, yeah, without a doubt.
All right.
Business attire is the right way to go. For sure. Don't you agree with this? I'm surprised you're silent on this. They're going to go to the Senate floor in what, hoodie?
Camp than you.
A hoodie and shorts?
I think decorum...
Go ahead.
Decorum has slipped, to say the least.
There is also a sense of respect, but there's also a sense of service. And this goes back to a discussion of, are you representing, are you serving a nation, or are you trying to be an Instagram
My
star?
mother got dressed up to go to the grocery store, and she wore white gloves to go to the department store.
There you go, TK. Well said. It's like Trudeau in those light grey suits.
Okay? Well said.
G7.
Well said.
You have such issues with those light grey suits. I just think that
Trudeau's got a lot of problems right now. The light grey suit is also one of them. Just, just to
but
throw
he's got
that
great
in there.
hair.
He does. Something
So
I
it's
don't
all
have.
fine.
If you are just joining the programme, welcome to the programme. The S&P 500 negative here by 0.16%. In the bond market, yields are unchanged, 433.65. Looking at crude in the 90s, 91.27. Weighing in on all of this, Gilles Moek of AXA Investment Managers with a big week ahead. 3 major central bank decisions.
Yeah, we're 9 points under 4,500. I mean, the resiliency of the markets with 95
impressive.
Oil is stunning.
Given where the dollar has been over the last 2+ months, given where the 10-year is right now, where crude prices were and where they are currently, these are big changes and equities are hanging in there, Lisa.
Well, which equities? And this, I think, is important because you have seen a marked underperformance of the big tech names in the U.S. They have not kept up. And this, to me, raises a question. Is this the beginning of something, or is this the dip that everyone was hoping for? It wasn't even a dip. It was just a lag. Yeah.
0.1%.
You don't see this on radio, but behind John is St. Walls. I just saw some birds there. Feed the birds, tuppence a bag. They're doing it.
Is that what you're going to be doing later?
Yeah, that's what they're doing. I just saw the birds over there. You know.
Do you want to sing us out? You're desperate to sing us out. David Welch on the UAW strike out of Detroit, coming up next.
an average of 92 does allow oil prices to go to 100, we're putting out a piece later today, which is calling for $100 by Halloween for Brent. And again, this is just a trajectory. And at this point, look, of course, it's a short-term thing, right? I'm not saying it's going to average above 100, but could it go to $100 for a bit? Absolutely, yes.
Absolutely, yes. Triple-digit crude by Halloween is the call from Amrita Sen, the co-founder and head of research at Energy Aspects. Crude right now on WTI, 91.37. On Brent, getting closer and closer to 95, 94.50 currently. Outside of that, in the equity market, futures just about unchanged, negative 0.1%, rolling over in the last hour or so. In the bond market, going nowhere, 433.65. Talked lots about that record run, that weekly streak of dollar strength, 9 weeks of it against the weaker euro. 106.66. Positive this morning on that currency pair by 0.08%. The story for the three of us all week potentially, and maybe for longer, the strikes from UAW against Detroit's big three, not one, not two, but all three major manufacturers over in Detroit. And TK, the ask, 40%, 36%. What they've been offered at the moment is 21% over at Stellantis, and the pushback was pretty swift. That wasn't entertained really in any way, shape or form.
Well, the two of you mentioned this, the pay is front and center, and that's what gets the media's attention, but I'm looking at all the other attributes as well, and particularly the ability of the union to capture present and future electric vehicle jobs. I'm not hearing enough about that.
How do these guys compete with China?
How do they compete with BMW in the Carolinas, or 3 plants by Atlanta? That's what I don't see.
How do they compete with Tesla?
Well,
that's what Dan Wedbush said. Look, I get it. Tesla bull, I understand. If you were bullish before, you're bullish now. But surely, you're looking at this play out. Union versus non-union. It's a pretty clear investment thesis there, isn't there, Lisa?
Which is the reason why some people think that the reason why you're seeing this playbook from the UAW is to try to capture some of the workers from Tesla, to say we actually can make inroads at a time of technological change. They're throwing it all out there because a lot of people view this as the last opportunity that they have to do this. And if they don't get those workers, you're right, it's game over.
Yeah, we're going to have to see here. Right now, we're going to get a briefing, and we have been so advantaged by our Detroit shop, I should say. He is our Detroit bureau chief. David Welch joins us on the worry of industrial decline. David, you and I lived it on the New York Thruway. It was Carrier in Syracuse. It used to be a huge operation for Syracuse, New York, and then there was manufacturing decline and the Eastern Rust Belt. Is there worry here about manufacturing decline in Greater Detroit?
No, there's always a bit of a what me worry sort of thing when it comes to that. By the way, it wasn't just Carrier, it was GE and Miller Brewing and a whole bunch of factories, so there's nothing left up there. But look, there is concern about being competitive with Tesla, with being competitive with Japanese, Korean factories. At the end of the day, though, for automaking, labor is, it's well under 10% of costs comes from labor. And if you boost wages up by 5% a year, it's not like suddenly every vehicle loses money. It cuts into what have been record profits, but it's not something that devastates them. They are at a competitive disadvantage from labor costs. They already are, and they will more so. And look, now the union's going to make a big stink about this. And they've been saying that they need to organize Tesla and organize Toyota plants. They've never been any good at it. They've just routinely failed. They've never failed to disappoint when it comes to that. And so if they get a good contract, they've got to be able to say, go back in 4 years and say, look, we did organize these other plants and we're driving the wages up.
Have you been surprised or understanding or interested in how the executives of the three auto companies have reacted?
Look, actually I have. They've voiced frustration. You can see that from Farley. Farley's a pretty open guy, pretty colorful guy when he speaks. Mary Barr is always composed. You guys have interviewed her. She's always on message. For her to come out and say she's frustrated with the union really says that they're having a tough time with Sean Fain and a tough time getting what they think is a fair deal. And, in the story we have out today, Bill Ford said to the bargaining committee, he said, I can look you in the eye and I can say, I believe this is a fair deal. And I don't think he's wrong. It was a pretty good deal that they've got, but the union's they're gonna run it to the brink and try to get more.
What are they after, David? You and I talked about this a number of weeks ago, and I said, what do you think gets it done? And you said something like 20%. And at the time, I thought, yeah, 20% sounds about right. That's the offer right now. Ford 20, GM 20, Stellantis 21. What do you think gets it done now?
It's tough to say. I mean, I don't think it's a lot higher than this, and clearly you and I were wrong on that before. But the tenor of things did change over the weekend. The union, reporting coming out of the union saying that they made progress with Ford over the weekend, kind of a more neutral to positive view of meeting with General Motors, and they're reconvening with Ford and Stellantis today. So it went from heated, nasty rhetoric about greedy billionaires and awful CEO salaries to we're making some progress. To me, the big thing isn't really going to be wages, because I first off, I think 21% would get it ratified with the membership. But does the union really stick to its guns on pensions, or was that kind of a throwaway demand in order to get leverage for better raises and cost of living allowances? The companies will take a very long company-wide strike before they give in to pensions, period.
Unionization has fallen really dramatically. I was looking at one figure. It's about 6% of the population, of the working population in the United States, from much more just a little bit ago. Is this whole action by Shawn Fain going to actually get more membership, increase the actual participation in areas like electric vehicle making?
Well, I think he will have success organizing some of the battery and electric vehicle plants simply because of the relationship with Detroit's three automakers. They've already organized the Ultium plant in Ohio. Of course, that's jointly owned by GM and LG. And they'll get wages up there, and that could help them organize some of the other battery plants owned by other companies that are coming over the next few years. So, yeah, I do think that will help. In fairness to the UAW, there is a moment here for labor. The public perception of unions is much better. It's actually, favorable 75% now, which is double what it was about 5 years ago. You have successful organizing drives at Starbucks, at Amazon distribution centers. So there is good organizing going on. And look at what the Teamsters got out of UPS without even going on strike. They got a great contract there.
Amazing.
So I do think if Fain can score some victories here, workers will start to see the value of joining a union. And there's a lot of anger out there. Look, I think one of the toughest things for the companies to explain, everyone knows that a CEO is going to make a lot more money than somebody working the line or even a rank and file engineer with a degree. But the fact that, they now make, someone put a figure out, 200 times what the worker makes, and it used to be 30 or 40 a couple decades ago. The fact that their pay went up over 40% and union workers' pay went up about 12%. It is tough to explain that to a public that's very anxious about AI and worried about losing jobs to EVs and worried about income disparity.
Yep.
With the cost of housing, cars, food, and college tuition soaring faster than income does. It's really tough to explain why very wealthy executives get to more than compensate for that sort of inflation, and workers have to eat it.
It's almost impossible for them to explain currently. David, appreciate your time, sir. As always, David Welch there of Bloomberg out of Detroit on this battle between Detroit's Big Three and UAW to come to some kind of labour agreement. Lisa, as you often do, nailed it about attracting workers from elsewhere.
This, to me, is one of the biggest questions. We're seeing this boost in union activity, striking activity that is now the most over the past of this year, going back to 2000. And you're starting to see real pushback. So what is the next sector to really get hit with this? It can't just end here.
But imagine if Teamsters had lost at UPS. The fact is they won at UPS, and there's a wide understanding they're going to win again here. I didn't hear that from David Welch. This is not UPS saying, let's get this done so we keep the trucks going. I don't get any sense of that here.
What's your position on eating on morning shows? In America, they always eat. You see what Bramo's got for a birthday?
Oh, look at this. Oh, my word.
I'm just shoving it in my mouth.
For Bramo?
Yeah, it's good. And that'll go really good with the hot brown water. Somebody said
absolutely not.
Go for it.
Absolutely not. They do that on US morning shows.
Yeah,
They're like,
exactly.
burgers
They have a
and
cooking show.
eat ice cream.
It's like people
It's
come
not
in,
meatloaf.
and then we sit around. We all like, oh, I like the
birthday,
creaminess.
Bramo.
Oh, you know, if I ate this, the look you gave me.
TK absolutely crushing Bramo's birthday cakes in the commercial break.
Is that right? With my Yorkshire tea.
Two down.
My Yorkshire tea.
Nice.
Somebody emailed in. They said, "What kind are you having?" I said, "Not PG. I'm going with Yorkshire."
You're calling it brown water for your
hot brown
one-week
water.
stay.
Yeah,
I imagine you'll get kicked out of the hotel for that. Equity futures on the S&P, positive. They're negative, up and down and all around. We're down by about 0.1% on the S&P 500. On the Nasdaq, we're down by 0.2. A little bit softer here. The Russell's still higher by 0.14%. Flat equity market, down on the week last week, but pretty flattish anyway. We were down by just 0.1%, not even by 0.2. In the bond market, 2-year, 10-year, 30-year. 2-year still around 5%. 10-year still in the 430s, 30-year still in the 440s, going into the Fed on Wednesday, Tom, expecting an unchanged decision, but maybe some changes to that outlook in the economic projections they supply every quarter.
Am I right that they're going to, the guesstimate from Mike McKee is they're going to raise the growth view?
Growth up, inflation down for 23.
Not to Atlanta's stupidity, but, you know, lift it up a little bit.
A little bit, and then look to 24.
Yeah,
that's where the surprises might
Let's
come
go
from.
back 9 months. We're on the edge of October here. We're talking about Halloween and $100 oil with Emery Sen. Go back 9-10 months. Did anybody think the equity markets would be here with the data check John just did? No way.
How many stories have you read recently about how wrong everyone's been and how just people keep repeatedly getting everything incorrect? And I thought that was really interesting in light of this Financial Times survey of economists talking about how more than half of them think, or almost half of them, think that the Fed is going to raise at least twice more before they are done.
As I'm often reminded, they are year-end forecasts, so you know, there's still 3 months left or something like that. Who knows?
And they could be right just late, right? I mean, honestly, they could have the correct thesis.
Could you do a 2024 outlook right now? Could you provide us with any insight whatsoever on what
I could
you
provide
expect
you with one.
in 2024? I've got no idea.
No, I can't.
24? No idea. We're going to be pushing out the recession game again? Is that what 24 looks like? Who knows?
I think I would predict there will be continued recession foolishness. And Neil Dudd has been brilliant on this. You know, I think it's feasible. What we're going to do right now, this is really important. We're trying to piece together, with the trip to London, the credit conference we'll be doing on Thursday, we're really trying to piece together 2024. They're the political conventions in America and that. But front and center for Bramo, John and myself, is we need tickets to the Paris Olympics. The only reason he's with us now with AXA Investments Paris, Gilles Moek is with us here. Give us an update right now on Mr. Macron, AXA, and the Paris boom you're going to see. Can Paris get any more boomier than it is now off the Olympics next summer?
Right, it's looking good. I guess tourism is helping a lot. So yeah, I mean, the city is having a good run. Gas is going to continue until the Olympics. Now the country around Paris, it can be a bit more complicated. We've had a good first half of the year. Things are starting to look a bit more complicated. So there's a lot of positivity at the moment in France, because if you compare yourself to Germany, things are so much better.
Right.
Even the German stellar step now, so it's quite unusual. But actually, if you look at the latest business confidence survey, it's not as bad as in Germany, but it's also heading south.
This is really important, because I think to our listeners and viewers, particularly in America, when we say we went to France, we went to 3 arrondissements wrapped around Notre Dame and the wonderful repair of that cathedral. We don't have a real picture here of the greater European economy. We just see the boom of European tourism. Separate the European tourism from your caution on the rest of the European economy.
Yeah, I mean, definitely the weakness in the euro is helping from that point of view. So tourism is actually a function of that weakness, the rebound in the US, I think the appetite for traveling to Europe at the moment. But you know, even in the most tourism-sensitive countries in the Eurozone, it's 15 to 20% of GDP at most. And the rest is the usual stuff that is dependent on either world demand in the generic sense of the meaning, or on consumer spending. And consumer spending in France, for instance, has been contracting for 2 quarters in a row. So we have to be, yes, a bit broader in our assessment of the situation.
It takes us to the ECB, so let's be slightly provocative in this question. Trichet 2008, Trichet 2011. Should we add Lagarde September 2023 to those?
Well, they're trying hard not to fall in that trap, because actually if you compare this with 08 and with 2011, there was not a great sense of caution at the time when they actually hiked. There was a sort of self-righteousness, so we are definitely delivering what we need to and we're probably going to continue. Whereas this time it feels very much like it's the last hike that we probably need, maybe for tactical reasons internally, to get the hawks on board. Also because I think it's true there is a resilience of inflation which is more tangible in Europe than it is in the US. But the entire body language from Christine Lagarde last week was about, yes, they're now selling the long for, the high for long, sorry. But in terms of further hikes, we're probably done. And I think, yes, what happened in 08, what happened in 2011 must be on their minds. And even the hawks are getting a bit less vocal, I would say.
I've noticed the same thing. It begs the question about what we can learn from the European experience on the other side of the Atlantic. Do you think there are any lessons? You see Germany essentially go into recession and inflation's still a problem. Growth in Europe essentially stagnate and inflation is still a problem. Is softer growth the cure for what we're experiencing at the moment?
Well, I know that lots of economists, including myself, have been wrong on that for the last year, but history would tell you that it's very, very, very hard to get disinflation without proper pain in the real economy, especially when inflation is no longer about exogenous forces, it's about your domestic forces. So as long as proved otherwise, I would say that what's happening in Europe is probably a lesson for what might happen in the US, even if, yes, the US resilience is amazing at the moment. I guess a big difference between the two is that there's, I think, in Germany a more structural issue, which is coming back to bite them at the moment, which is to some extent, to say, disconnected from monetary policy. They would be probably in a softer patch anyway, and that is dragging the Eurozone average down. But you want to kill inflation, especially when it started to get entrenched in wage negotiations. You probably need to engineer some sort of softening of demand. There is not a lot in the textbook that would tell you otherwise.
Is Europe completely different than the U.S. when it comes to how well it can withstand the oil shock, or just perhaps oil prices going back to something more normal on an inflation-adjusted basis?
Well, our big problem for the last 2 years has been gas rather than oil. But on average, we tend to be more sensitive to oil shocks than the U.S. for complicated reasons, due to the fact that even if we are less oil intensive than the US, the actual price of a gallon of gas in Europe is much higher than in the US, and people are probably more sensitive to that particular item. But if it was just about oil prices, I don't think we would be really concerned. I think most observers at the moment are more focused on what's going on with food prices. Hopefully it will continue to slow down, at least this is what wholesale markets would tell you for most of that, and gas. And we went through last winter much more positively than what was expected. We need to do it again this winter, and to some extent it's beyond our control.
Which feeds into the whole discussion of wage spirals, especially in light of some of the labor movement that we've seen in the U.S., but also around the world, maybe taking a page from Europe, if anything. Yeah. How much do you think that that's more noise than signal, or vice versa, in terms of wages staying sticky and labor power continuing to be stronger than it has been?
No, I think there's something profound happening there, which is that there has been a change in the balance of power between employees and employers. I mean, it's very trivial to say that, but in Europe, where we have in most countries a collective wage bargaining system, what we tend to have is more inertia in the way wages react. I mean, in the US, you could make the case that wage accelerate when people actually can leverage the job opportunities and go back to their employer and ask for a pay raise. It's not really the way it works in Europe. I mean, some of it obviously happens, but most of the pay increases here happen as a result of collective bargaining. And it always takes a while for instance, the unions to realize that maybe the economy has become softer, job opportunities are falling, maybe it would be time to move back towards wage moderation. But you need actually a proper proof that the labor market is softening. And even in Europe, And that's actually one of the big positives of our current situation is even in countries which have been used to mass unemployment for decades, the current situation of the labour market is more than okay. I mean, take France, my country,
Right.
Unemployment rate at 7%. If you had told me that France would be able to deliver that 10 years ago, I wouldn't have believed you.
I got 8 ways to go here, but just because of time, then can you state Europe is vaulted beyond eurosclerosis?
I mean, eurosclerosis is, I think, in many cases, what we have is sort of a magnified version of what happens in the US in terms of demographic changes, for instance. We are a sort of more acute version of what is going to happen in the US anyway. But one point on which I think Europe at the moment is doing better than the US, it's on participation. The big positive right now in Europe is that our participation rate is rising and has been rising through the pandemic. It's today much higher than it was before COVID. It's exactly the opposite of what's been happening in the US, even if there has been a catch-up recently. We've put more young people, more older people back to work. And basically, I think we are benefiting from structural reforms which have been pushed through in Europe for the last 20, 30 years. Not spectacular ones, but gradually, I think we have a much better functioning labour market than what we had 20, 30 years ago. And it's definitely positive.
Jill, that is a bright spot. Thanks for being with us. Jill Moak of AXA Investment Managers. Europe finding itself in a very difficult spot after the ECB decision that we saw last week from President Lagarde and the Governing Council. It did feel like a bit of a trade-off, Tom, between Doves and Hawks. A deal that was struck just to get that extra 25 basis points. But as Jill mentioned, and I think we've been talking about this over the last couple of weeks, even the Hawks on the Governing Council at the ECB weren't screaming for a rate hike going into this decision, which I think speaks to the moment we're at right now. I would say the same thing over at the Federal Reserve as well. If you hear from a hawk on the FOMC, they'll talk about the prospect of maybe going 1 and maybe staying there for a long time. But they're not screaming for 50, 75, pushing this much further than where we already are.
To go back to our early conversations, and particularly with Jeff Yu earlier this morning, it comes down to a mass adjustment over a new rate regime, and that the negative rate regime, I believe we have Folkers Landau with us here through the end of the week, and the answer is a negative rate regime is gone. And we're adjusting to that right now.
And likely not going back to it. Very short, just short of 92, very close to 92 on WTI, I should say. 91.99 on WTI just moments ago, 91.83 at the moment. And a 2-year yield that's higher by 3 basis points on a session. Lisa, 5.06% on the 2-year currently.
Markets are buying into the idea that the Fed might not cut rates in the future, at least not next year, or at least not until later next year. And that is the change.
Slowly internalising that message in a much more profound way. If you are just joining the programme, welcome to the programme. The S&P 500 on equity futures right now negative by 0.09%. In the bond market, 434. In the commodity market, we talked about that crude move at 91.80 and a euro 106.59. It's a quiet start to the week. The week really does begin on Wednesday. Got a couple of days of quiet mornings, I think, in store potentially, based on what's on the schedule. Then it's on to Wednesday when you get that Federal Reserve decision. Thursday for the Bank of England, Friday for the BOJ, and then you get some PMIs as well for the month of September, Tom, to end the week.
Well, they end the week there, but I'm still recovering from this weekend. Thank you for teaching me about Formula One.
Oh, what a race, eh?
Singapore, Lisa, it was nuts. They're on the streets of Singapore that I've been on. They're bouncy, bumpy. They're wicked narrow like Monaco. The violence, John, near the end of the race.
Serious endurance test.
Yeah.
That Formula One race is.
And
so I'm taking off. I'm at JFK yesterday morning in New York, and there's like 10 laps left. And we start doing that taxiing thing. I lose the signal, and I don't get to see the last 5 laps of this race. And the last 5 laps of this race were just magic. You've got Russell and Hamilton and Mercedes chasing Norris, Lando and a McLaren, and Sainz in a Ferrari. And Russell goes off on the last lap?
He goes off in the last
Hamilton
lap.
can't
His
catch
tires just
Lando, and
wore out.
Ferrari get a win.
They were saying that Sainz, when he won, the tires were barely working.
Do you know what you did to him? He came to London and he spent an entire day watching Formula One.
I know he did.
Literally the entire day.
Watched quali, and then watched the whole race.
Well, the difference is we had it on the Gulfstream. It was great. We had the feed on the Gulfstream, which is really good. Yeah,
must be nice.
David Livingston of Citigroup is coming up shortly. Equities right now down about 0.1% from London. This is Bloomberg.
One important thing looking forward, different to the last 10 years, is uncertainty around inflation. So we see inflation coming down towards central bank targets, a little bit above, but coming down over the course of next year. But I think clearly there's much more uncertainty in the inflation picture for the next few years compared with the last decade.
Andrew Balls, Global Fixed Income CIO at PIMCO. Clearly, Senator Schumer is not my boss because I've got to put my jacket back on for our next guest. Equity futures on the S&P 500, slightly negative. We're down by 0.1% on the S&P 500. Yields unchanged, 434 on a 10-year. Eyes on crude, 91.88 right now, 91.99 just months ago on WTI, and just short of 95 on Brent, 94.78. High this session was 94.89. And Rita Sen of Energy Aspects on the programme with us a little bit earlier this morning. That headline was always going to catch on, wasn't it? Triple-digit crude by Halloween?
Yeah, of course.
Scary stuff, TK, going into the end of October.
Well, it is. I mean, at the end of October, what we're going to see are including Jobs Day, which we haven't even touched upon after the Fed meeting here, but it's fluid. But I'm sorry, 94.79 on Brent crude. Is there any other story all of a sudden for our listeners and viewers? When does a gallon of gasoline pop? That's all.
Oh, that's happening. That's happening, Bramo. Equities just a little softer then in the FX market. Going nowhere here, Lisa, on the euro, 106.58.
I wanted to take a look just quickly at the auto manufacturers, including Tesla, since that is sort of the other side of this whole debate and what they were doing. And what you can see right now is Ford and Stellantis very much negative. Tesla actually joining the crew, although they did pop earlier this morning after the Wall Street Journal put out a report saying that Saudi Arabia is in talks about possibly building some sort of EV factory in that nation. I am curious, though, about the Stellantis underperformance, down almost 2%. Is there a signal here in terms of the union saying no to a 21% gain in their salaries? Does this mean that the bar is going to be that much higher and there's going to be that much more in terms of profit erosions after years of record profits?
We're going to have to see. I mean, it's the union day. When does the president speak again? I mean, what is the path forward Monday, Tuesday, Wednesday?
I spoke on Friday and he actually handled the situation pretty well, I thought, based on his address on Friday, given how difficult this position is for him at the moment. We said a lot of weight was on his shoulders to come out on the side of the union and the strikers, and I think he did that in some ways.
Please stay with us. Of course, Balance of Power tonight with Anne-Marie Horton and Joe Matthew on what's going on in the United States. We're in London, and what that means is a sense of international banking for the banks of the United States. No one, not so much uncertainty, but is in a mode of restructuring, is Citigroup. Jane Fraser has called upon David Livingston to be her chief client officer, to pick up the pieces and to move forward for a stock that has been challenged coming out of the great financial crisis. David, thank you for joining Bloomberg this morning.
Tom, great to be
What's
here.
mission number one? What has Jane Fraser said to you? This is the marching orders. Go.
So we now have a structure which fits our strategy. So our strategy didn't change on Jane's announcement last Wednesday. What did change is the structure that's going to implement that. And in my new role as the Chief Client Officer, which is a new role in Citi, is very much to say we cover clients around the world, tens of thousands of them and millions of them in the US in our personal banking business. Are we doing it the best way we possibly can? Are we as coherent as we can? And are we delighting them as much as we possibly can with our capabilities? And so the number one is to make sure that we bring that dimension through all of our decision making.
You were an undergraduate in Australia a few years ago. It's the same then as it is today. You have to have a distinctive defining feature. What is going to be the defining feature of Citigroup 5 and 10 years out versus the other major U.S. banks?
Always going to be two dimensions on that. One is the fact that we offer the broadest set of capabilities, and particularly institutional client capabilities of anyone. And secondly, we do it on a geographic dimension, which is we are the most international organization. We do business in 160 countries around the world, and that serves our client base. That's those clients with cross-border needs of whatever nature, financing, payments, advice. That will continue to be the distinctive feature of Citi.
David, the uncomfortable conversation, it always is, job cuts. Are they focused or going to be focused on specific geographies or functions? How's that going to work? What's the approach?
So I think, firstly, job cuts is not the story here. It is unfortunate. We will have people leaving the organisation, some very talented people leaving the organisation. But that's not where we started. We started with the need to simplify our structures and our management routines, and therefore the job cuts of the output. They are going to be, as you've seen, that there is my former role as the chief executive of Europe, Middle East and Africa, that layer, the Asia Pacific layer and so on, they are being taken from the organization, as are some of the capabilities that we had sitting above our products, which now our businesses report directly to the CEO. So it'll be in those areas where if you like, the reduction in the number of roles that we need will be felt.
Do you have a decent idea of numbers already?
We're not talking about numbers at this stage. We're talking about the strategy and the change in structure.
Because you don't want to focus on them, but internally there must be an assumption of what the number is right now.
There is a sense, but again, that's not exactly where we're spending the core focus of what we're doing.
The reason why we're talking about things like this and the reason why people pick up on the idea of job reductions is because it seems like even though banks had been looking for higher yields for so long, it's been difficult to pass them along in a meaningful way at a time where people are worried about recession, people are worried about the ability to repay those loans. How much are you expanding your loan book? How difficult is it at a time when you are seeing those concerns about recession looming on the horizon?
Different answer in different parts of our business and different by geography. If you take the United States, for example, the US is, as we know, flush with liquidity, which has been stimulus, which is from the US government. And so therefore, loan growth and demand at the consumer level and even the institutional level has been a bit more muted. If you take also what's happened to interest rates, particularly companies are looking and saying, what is the profile of interest rates and when is the right time to borrow, particularly entering into long-term commitments. And it's not that there's no activity, but there is cautious activity in terms of taking on additional or new leverage at this stage.
How do you acknowledge the difficulty, the complexity of the different regions that is specific to those regions while simplifying in a very new structure? How is that sort of going to be a challenge that you're going to work through?
We're not taking the regional and the geographic dimension out of Citi. That remains very, very sound, and we'll keep operating the company with a single international organisation outside of North America, and with 7 core clusters which exist today and will continue to exist, but will be given more autonomy and authority in order to be driving the client activity which is happening within their geographic clusters, which means that they address the situation that's relevant in front of them.
You are deeply experienced at this, and it's outside your remit to talk about shareholder return, use of cash, etc. But the crushing disappointment from Mr. Weil to Ms. Fraser has been the share price. It just hasn't moved off the 10-for-1 reverse split of 2007. How do you counsel Jane Fraser to move that stock price higher to where your competitors are?
So I think Jane takes counsel, of course, from many people, but I'd say she also is able to be decisive in her own right. I think what she's done in terms of this reorganization, again, where our structure now fits our very, very clear strategy, is that we have the best possible platform now in order to make it clear what our return potential is, because ultimately it's returns that will drive the share price, and we need to be able to demonstrate that to our investors.
Let's finish on some easy stuff. What's office attendance like in London at the moment for you guys?
It's improved, and
is it better than New York in London?
Yes, in some parts. I think it is. But they're actually New York and London pretty much on a par. But I think it's becoming very clear, not only to management, but also to our broader organisation, that being in the office is just so much better.
Are you making the 5-day push?
Well, our policy is three days as a minimum. So
is that
that's where we are.
4, then 5?
We'll see over time.
David's not wearing the shoes with the white soles. Just
no hybrids here.
No hybrids here. David, I'm looking down here. It's
David, thank you. David Livingston at Citi. Appreciate it. Fantastic. I know that was something you were focused on, Tom, coming over to London. Office attendance here compared to, say, New York.
My sense is that here it's better than, I wouldn't want to editorialize, but than the disgrace in New York.
Given the direction of travel, it starts at 3, Bramo. You know what happens. Then it becomes 4.
100%.
And then it's like 5.
Basically, this is the global executive class coming out and being like, it didn't work for a lot of jobs, and you need to come back to the office, and sort of easing into it with workers pushing back and now getting a better sense. Okay, I need to relocate back to the city I was working in.
It's celebration time, Bramo. We're going to take Bramo to the pub. Get Bramo a pint. We can do that because it's 1:56 in London, so that works, doesn't it?
100%.
5 o'clock
I saw
somewhere.
people at noon with big pint.
Coming up on Bloomberg TV, don't miss this, the Stellantis CEO at noon Eastern Time. Live from London, more through the week from us. Thank you for choosing Bloomberg TV. This is Bloomberg Surveillance.